we're at an inflection point, and it becomes difficult to know, are you moderating into a soft landing, or are you moderating and then slowing down much more sharply?
We should expect to see over the next several months probably still some more softening in the labor market.
On average, the consumer's doing fine, but there are pockets of weakness here. I think the Fed has to be attentive to that.
The consumer's searching for value because they don't have the stimulus dollars they had a couple years ago.
We do think that what's on the horizon is the risk that inflation actually picks back up again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now with your equity market on the S&P 500 pulling back just a touch. We're down 0.5% on the S&P, coming into September on a 4-month winning streak. The week is absolutely stacked. Let's talk about payrolls. The estimates look like this. The median for Friday, 165 on headline. That's up from 114. For the unemployment rate, Lisa, 4.2%. That's down from 4.3.
So basically, everyone is saying the important day is going to be Friday, pretty much across the board. This is the big test for an equity market that typically does poorly in September. Let's just put it there clearly. But clearly to this week, everything hinges on that, with sort of the drumbeat up to it with the JOLTS report, the beige book, some of the ISM services that come out on Thursday as well.
Here's a flavour of a question we're going to ask repeatedly over the next few days. How bad does it need to be to go 50? How bad does it need to be? Seth Carpenter, Morgan Stanley. Lisa, we think a print around or below 100K this week will clearly put a 50 basis point cut on the table.
Yeah, this to me seems to be one of the key questions. We heard from Citigroup that it was 125. That would put 125,000 jobs. That would put 50 basis points squarely on the table. Key question is whether the Fed has given up the idea of a 2% inflation target. And this is something we're going to speak with some of our guests coming up. If they sort of tacitly acknowledge that they would prefer to rescue the labor market over achieving that 2% inflation target, that opens up the door to a 50 basis point rate cut, even without severe labor market pain. Question to me is bad news bad news? And Stuart Kaiser just sort of hammered home on this over the weekend, saying bad news is bad news and good news is good news. Don't get your hopes up that a 50 basis point rate cut is really going to support an equity market that kind of has the balance of risks to the downside.
The labour market at the centre of absolutely everything. It's been a really busy couple of days on the campaign trail at AMH. Courting the union worker vote, a big theme of the last 24 hours.
Absolutely. Kamala Harris yesterday in Pennsylvania alongside Joe Biden. Joe Biden, of course, went ahead and said, we usually hear from him that he's proud to be the most labor union friendly president, and she will be too. This was him basically giving his blessing to the union voters that Harris will follow in his footsteps. And she came out and she said, U.S. Steel, that company that has been the back and forth between the United States and Japan, U.S. Steel should remain in domestic hands. You're going to see a lot of this because guess what? We are 9 weeks today from the U.S. election. And what did Libby Cantrell tell us? Enjoy your summer holiday. Start paying attention to the polls after Labor Day. Well, here we are.
Okay, not to go on a rant in the morning. It is Tuesday morning. But there is this feeling, are we really talking about policy here, or is this sort of messaging? Is this sort of a vibe kind of to give out there that I'm on the same vibe with Joe Biden? Joe Biden never said he was actually opposed to this deal in the way that he was going to undermine it or actually scrap it in itself. Same question with Harris, right? How much is this a viable company without some sort of infusion of cash? And oh, by the way, a competitor that tried to buy them was rejected for making an anti-competitive bid because essentially that would control all the steel assets in the United States. So when you take a step back, how much is this noise and how much is this actual policy?
You know, the last month is just about vibes. I hope the next week isn't just about vibes. We're a week away from an actual debate between Harris and Trump. Are we actually going to get that debate a week from today?
Yeah, we're supposed to have the debate. It better happen. And right now, I think both camps want to see it happen. If you look at the polls, we're pretty much frozen now until that debate to see who is going to take the edge. Yes, Harris has absolutely closed that gap with Biden lagging behind Trump. And in our Bloomberg Morning Consult poll, you do see her head in the swing states. But all of this is within the margin of error. And it's really important that that debate, I think, significantly is taking place in Pennsylvania. This is going to be the must-win for the Democrats, and this is something that was able to put Trump over the finish line in 2016.
2 months away from a general election. If you are just joining us this morning, good morning and welcome to the programme. Here are your scores in the equity market on the S&P 500, pulling back by 0.5%. In the bond market, yields just a little bit higher, back to 390.54. In foreign exchange, lots to talk about with dollar yen. Dollar yen down to 145. It's a break of 146. Some yen strength out there. Governor Veda recommitted recommitting and reinforcing this idea that they're going to hike interest rates sometime soon. We can park the Japanese story just for a moment. Lisa, the data this week, ISM, services and manufacturing, ADP, take your pick, payrolls Friday. I'm losing count.
Well, payrolls is really the main event. And pretty much every note over the weekend was talking about how this is going to make it or break it with respect to the tone in equity markets. Just to give you a flavor of what we heard over the weekend, payrolls are almost all that matters for equity markets. That's Citigroup's Stuart Kaiser. The true test will likely come with the August jobs report on September 6th. That is Mike Wilson. That is on Friday, but the drumbeat up to it. The JOLTS data on Wednesday, really key tomorrow, as well as durable goods. Today, we're going to get ISM manufacturing, but ISM services may be even more important on Thursday, along with jobless claims. Really, to me, ultimately, though, this is all leading up to whether or not we really see true weakness, because a lot of the data that we got over the past few weeks kind of rebutted the weakness that we saw briefly that caused the huge hiccup in equity markets. Can you see this rotation into small caps without that jobs report being good news, and good news is good news?
We mentioned this last week. Going into August 2nd, a couple of things happened. It wasn't just a bad payrolls report. It was the ISM manufacturing read and the employment subcomponent coming in really, really weak. So, Lisa, in many ways, that's something to watch a little bit later this morning.
Whether it was an anomaly and whether it matters, because pretty much as soon as we got that number, there was an entire peanut gallery of people coming out to tell us that it is inaccurate, and for anything to trade off the manufacturing ISM data is bonkers. And we heard that from one person after another. And then other people said this is a reason why the sky is falling. So which is it? And that's the reason why, it'll be interesting to get confirmation of that and how much just sort of gets overshadowed by what happens on Friday.
A lot of data just around the corner. Coming up on this program through the next 60 minutes, we'll catch up with Marvin Lowe of State Street with stocks near all-time highs. Terry Haines of Pangaea Policy as Harris makes a big play for union workers, and Neil Dutta of Renmac ahead of a busy week for economic data. We begin with our top story. Stocks kicking off September near all-time highs as traders await key payrolls data this Friday. Marvin Lowe of State Street writing, the Fed put is alive and well, with Powell's desire to preserve the still strong jobs market becoming job number one for the Fed. Marvin joins us now for more. Marvin, welcome back to the programme, sir. I want to start with Friday and payrolls and the question we teased at the top of this hour. How bad does that number need to be to open a door and leave it wide open for a 50 basis point cut?
Yeah, I mean, the Fed clearly got concerned with the last payroll report. It was down, closer to 100,000 for sure. I think that what we're looking for is a confirmation that that's the actual trend. Whether the number is 1 to 125, I think it's somewhere in there. But probably more important, it just shows how quickly the labor market could be decelerating, which is really what the Fed was guarding for at Jackson Hole.
Marvin, how different are things right now going into September 6th compared to how we were set up going into August 2nd? How much has changed?
Yeah, I mean, certainly, the SOM rule and, the headlines that got really puts the spotlight on the jobs market. I think going into the July report in the beginning of August, there was still a view that we were moving towards a more balance of risk in terms of how the Fed was looking at the markets. I think what I heard from Jackson Hole is that we've moved away from really worrying about inflation. Certainly, the PCE print that we got last week showed that we didn't need to worry about it as much. And the balance of risk is certainly on the downside of the labor market. That's a pretty significant change.
Just to put these two ideas together, when John asks how bad does this number have to be for the Federal Reserve to go 50 basis points, are we basically stripping out some of the scenarios where the Fed could cut 50 basis points, and that could be a good thing for risk assets?
I was never in the camp that 50 in September was a good thing. I really felt that if they really felt they needed to go that hard, there was something that they saw that they were really, really worried about. I think that they would rather go a very methodical 25 basis points. We could argue if November is part of that in the middle of the election, but really kind of that 25 basis points going into next year. I think that's soft landing in my mind. I think anything more aggressive than that really shows that the recession risk has gotten higher.
If you put that together with what you write here, the Fed put is alive and well with Powell's desire to preserve the still strong jobs market becoming a job one for the Fed. It raises this question, is there a possibility that this Fed is too late? And is that kind of what 50 basis points says?
Yeah, it certainly is a possibility. We're not seeing it in the data that we're focused on. We do think that there is the potential that we get a revision or we get some anomalies that kind of came out of that 114 number. The weekly claims numbers still seem to be fairly solid. And, really the engagement of the consumer attitudes out there are one that are still somewhat supportive of a continued jobs market. So we don't necessarily see the need for the 50, but, certainly the market is going to be focused on the recessionary risk that comes out of that number.
Marvin, would 50 look political?
It would. It would. Unless we get a number that we can't argue, a 20 basis point increase in the unemployment rate, something like that. It's always going to be political. There's always going to be one party that's going to be happier and one party that's not. So I don't think you can avoid it, but 50 certainly puts a spotlight on it even more.
Given we are 9 weeks to the U.S. election, how focused do you think the Fed is? Obviously, they're on the data, but at that conversation they may have about not wanting to look political in nature.
Yeah, I mean, certainly it's something they're probably talking about in the corridors. I don't think we're going to see that in the minutes ultimately. Remember that they did move the November FOMC meeting to a Thursday rather than a Wednesday because they were worried about potential market fallout, in my view, in terms of making that movement. So they're certainly cognizant of what's going on in the political landscape. And given how energized this election process is, they need to be guarding against it. Kind of having said that, the data is really job one for them in terms of what they're looking at. I think that's really the only thing that's dictating it. But, for sure, they would rather avoid any signs of being political in this process.
Marvin, let's finish on dollar yen. It's a break of 146, 145.88. We're negative about 0.7% on the session at the moment. So that's some yen strength for you. There was a document submitted to the government by the Bank of Japan Governor Kazuo Ueda, who basically reiterated that the BOJ is intending to lift interest rates once again. That's fueled a little bit of a further leg, a move lower in dollar yen. And Marvin, when I asked you how much has changed in the last month or so, I think that's a question we're thinking about in regard to the FX market as well. Have we released enough tension from foreign exchange? Do you think we've cut the link between what is developing with dollar yen and what is happening in equities?
I mean, I think that some of that carry trade that you're inferring did start to go back on maybe over the last couple of weeks, but the amount of froth that we had kind of going into that last rate hike from the BOJ has certainly been released. And now we're going to be able to trade a bit more on the fundamentals of what's going on in Japan rather than just really those interest rate differentials.
Marvin, thank you, sir. Marvin Lowe there.
Thank you.
Of State Street. Lisa, 145.89 on dollar yen.
You asked this question, and I think it's the right one. Is this releasing enough pressure on an overweight of the dollar that we have seen pretty consistently over the past almost 2 years now? And this is Kit Jukes' response from Societe Generale. The best the dollar can do as this long position unwinds is to fall slightly and slowly rather than faster and further. And he talks about how net foreign buying of U.S. bonds and equities was a record high in 2023 and has continued this year. So it is not just about sort of positioning on some sort of long-short carry trade basis. The carry trade is what everyone has been doing by piling into U.S. assets, as the U.S. exceptional story has really been the dominant theme over the past 2 years.
We've accumulated a big dollar position over the last couple of years, and we'll see how much of that we can unwind in the next few weeks. The next big stop is Friday. For payrolls Friday, the estimate is something in and around 160, which is up from the 114 we printed just about a month ago. Equities right now on the S&P 500 negative by 0.5% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Morning, Danny.
Good morning, John. Hewlett-Packard says that it intends to pursue a $4 billion damages claim in London against the estate of the late British tycoon Mike Lynch. HPE won a British civil case over the collapse of Lynch's company, Autonomy. It's now waiting for a ruling on just how much is owed. Lynch and his daughter were among those killed when his luxury yacht sank in Italy last month in a severe storm. Cathay Pacific has canceled almost all of its scheduled flights from Hong Kong to Singapore. It's inspecting the engines on its Airbus A350 planes. Sources told Bloomberg that engineers are checking for deformed or degraded fuel lines on the Rolls-Royce-made engines. A component failure had forced the return of a flight from Hong Kong to Zurich on Monday night. The airline says it's already found the same component failure across a number of engines. Elon Musk's Starlink has reportedly informed Brazil's telecom regulator that it will not comply with a court order to block X until its local accounts are unfrozen. Brazil's Supreme Court ordered the blocking of X based on the platform's allowance of hate messages and false information about the country's electronic voting system. Musk then threatened to seize Brazilian government assets unless property belonging to X and SpaceX is returned. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, courting the union vote.
When unions are strong, America is strong.
We will continue to strengthen America's manufacturing sector.
A busy 24 hours of campaigning for the Democrats. That conversation up next, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
Summer's over. Summer's over. Summer's not over.
Really?
Decent weather this week in New York City. Get out there, enjoy the weather.
Okay.
We're blessed to have great weather in New York this week.
Is this your crusade? Right. This is your popular cause.
Just, you know.
You want summer to be longer. You think that Americans end their summer too quickly. Is that basically the shtick?
We're not children anymore. You know, summer might be over if you've got to go back to school.
How can you say this? In Europe, they have a 2-week vacation. They have actually a month vacation. August is basically a vacation in Europe, right? So what happens after that?
In which case, for the Europeans, you can make the case the summer might be over.
So essentially,
they've had their 1 month off.
Rachel?
How many Americans took a month off?
Also, now's the time for actually really good deals because people think summer is over. In September, you can get amazing resort deals.
Summer's over for the kids. Yeah. I get that. For the adults,
I'm going to be
on board.
I'm going to be off for the rest of the week. I'm going to continue my summer.
Do what you've got to do.
No, you can't this week. Big
Take
data.
Your time.
It's true. It's going to be big.
Come back on Friday for payrolls. Equity futures right now on the S&P negative by 0.5% in the bond market, just about unchanged, 390.34. Under surveillance this morning, courting the union vote.
We know the simple truth. Wall Street did not build America. The middle class built America, and unions built the middle class.
When unions are strong, America is strong.
We will continue to defend Social Security and Medicare and pensions. We will continue to strengthen America's manufacturing sector.
So here's the latest. The Harris campaign dialing in on the union vote over Labor Day with events in Pittsburgh and Milwaukee. Attention now turning to the first and only scheduled debate between Harris and Donald Trump just a week away. Terry Haines of Pangaea Policy writing the debate is now the next known unknown and likely is the fulcrum upon which the election turns. That growing perception of a neck-and-neck race makes the stakes even larger. Terry's with us for more. Terry, wonderful to catch up with you, sir, once again this morning. Let's just start with that Labor Day campaigning blitz. Where are we in terms of the union vote and the union worker vote, and who are they lining up behind?
Happy summer or fall, John, depending. I think there's a big difference between union leadership and union rank and file, and you didn't have to go very far outside of Pittsburgh to figure that out. I mean, the line that the Biden-Harris people are purporting or to portray essentially is that the union leadership will help keep the rank and file in line and voting for. But that makes the mistake of looking at the union movement monolithically, when in fact there's a very big difference between, let's say, the teachers unions and the electrical workers and the steel workers and the Teamsters. So I think you have restive union membership who are really concerned about economic issues fundamentally, and that cuts into a union majority for the Democrats.
We've seen that in the rank and file when it comes to our own polling, Terry. What does Harris need to do to meet the rank and file voters, not just the union bosses?
Well, she needs to talk a lot more about economic consequences and what she proposes to do about them. Feeling the pain on economic consequences is a good and essential part. It's also the easy part when, in fact, monetary policy seems to have the whip hand on solutions in a world where no politician will do anything about fiscal. But she's got to get in there and talk about it, because that lack of appeal, that restiveness, that concern about the lack of what the existing administration has done is at the core of Trump's appeal everywhere in Pennsylvania outside the Philadelphia suburbs.
Terry, when it comes to Pennsylvania, how are you reading the polls? Our poll has her ahead, but all of this is within the margin of error.
Oh, very much so. And I agreed with what you said at the top of the show. I think she's righted the ship in terms of where Biden was, but Biden wasn't really that far down. This is it is the usual sophistry in one sense to say it's a turnout race and it's an enthusiasm race, but it is. And the entire game in Pennsylvania is going to be essentially two things. One is maximizing the vote in Philadelphia and the Philadelphia suburbs, and the other thing is to cut into Trump enthusiasm in the rest of the state. And she's got her work cut out for her in the second part. So at best right now, she's tied in Pennsylvania, I think.
Just as a reality check, Terry, you put out the idea of some of the quiet voters who really don't register in the polls. This idea that there are Trump supporters that give Democrats less of an advantage in certain swing states. Can you sort of explain your idea there?
The essence of the idea is that, and I think Trump works in this way too, is essentially that. There are core Trump supporters and there's the Republican Party, and they're not at all the same thing. But what you need to do is get to a point where Trump's view is he needs to maximize the people that are already for him. The Harris idea essentially is, I've maximized the number of people in the party that are already for me. I need to kind of move to the center and pick off the undecideds. Trump's bet essentially is that the enthusiasm from his core supporters washes out the broader Harris appeal. But given the enthusiasm gap that exists today, which clearly is more in Harris's direction, I'm not sure that's a winning bet on Trump's part.
At this point, Terry, I just want to finish with this question around U.S. Steel, because we were talking about this earlier and whether this is just a vibe in terms of Harris talking the same kind of talk that Joe Biden did, or is this actually going to be a policy where this deal is not going to go through with Nippon taking over U.S. Steel, even though there isn't necessarily a viable takeover candidate that can infuse this company with that kind of cash? What do you make? Is this basically just vibes?
Yeah, it's more vibes than anything else. There's a lot of, particularly in Western Pennsylvania, there's a lot of visceral pushback on the idea that United States Steel, essentially the original steel conglomerate, is going to be taken over by a foreign company, even one as forward thinking as Nippon Steel. But there's a situation where people understand in those areas in Pennsylvania, essentially that, promises towards Americanizing industry have been made for a couple of generations now, and they haven't stuck and they haven't been followed through upon. So what Harris risks, frankly, in Pennsylvania is deepening the cynicism that already exists there.
Terry, appreciate your input as always, sir. Terry Haines there of Pangaea Policy, much more on industrial policy and manufacturing, not just in the United States, but around the world in just a moment. Coming up on this program, VW considering factory closures in Germany for the first time in its 87-year history. Shocking news over the last couple of days.
And how much is this the beginning of something more? There was one analyst who put this out there from Citigroup. VW is recognizing just how serious the situation is. We're living in a difficult geopolitical world, and Europe has not won that battle.
Shocking, but not surprising.
Exactly.
The direction of travel over the last couple of years for that industry and for that country as well. More on that story in just a moment. From New York City, welcome back from the summer. Welcome to fall, apparently.
Good for you.
From New York City. Good morning. Putting together a 3-week winning streak on the S&P 500, kicking things off this morning. Good morning. Negative by about 0.5%. On the Nasdaq, negative by 0.7. On the Russell, we pulled back by almost 1 full percentage point. On the month last month, on the S&P 500, a 4th consecutive monthly gain for stocks and bonds alike. For the front end of the yield curve, the 2-year yield declining for a 4th straight month. Switch on the board and turn the page. The 2-year right now, 392.70, up a single basis point on the session. Lisa, going into payrolls on Friday.
Yeah, to a time when there's really a question about how far the Federal Reserve can cut rates without serious pain. To me, this is the ultimate question of this week, which is essentially, can you keep seeing this wonderful sort of nirvana rally and everything with bonds going down, but that actually being positive for risk assets, or do you get a reality check with there actually being the weakness the Fed would ultimately be responding to?
The 2-year on the month down by more than 30 basis points, unlocking some real dollar weakness. The worst month for DXY, going all the way back to November last year, I believe. The dollar index on the month down by a little more than 2 percentage points. But last week going against the grain, because last month we had the worst month of the year, but last week we had the best week going back to April?
Yeah, well, okay, so this is the issue. And frankly, for the dollar, what you're dealing with is the rest of the world. The rest of the world was looking a little bit better, and the Federal Reserve was going to cut rates, and that was going to add to this weakness. But now the question is, how far can some of these other countries go in terms of growth and in terms of rates that really could let the dollar weaken that much more? The ECB is a perfect example. And we asked this last week. How much can they really afford not cutting more than the Federal Reserve, given the weakness that they see everywhere else? I think the Bank of Japan is fascinating, its own story in and of itself, but there's a larger story of how big the overweight in the sort of long dollar position is and how that could potentially unwind over time as people realize that it's not just the U.S. exceptionalism story alone.
So let's turn to the BOJ. Dollar yen, a break of 146, just south of that right now at 145.98. A much stronger Japanese yen off the back of some comments from the Bank of Japan Governor Kazuo Ueda reiterating today that he's willing to raise interest rates once again. Not news, just reiterating something he's already said, this time in a document given to the government. How close are we to another rate hike at the Bank of Japan?
He seems to be hinting that it's fairly soon, especially because the data has been fairly good. This comes at the same time that it hinges on the U.S. and how close are we to real declines in benchmark rates. It's kind of tenuous right now. I'm curious to see how people are positioning and where the balance of risks is. Right now, is the balance of risks really to the upside in terms of yen strength or to the downside in terms of dollar strength? And ultimately, it feels like yen strength is kind of taking the front end right now.
This is your yen strength. Dollar yen, 145.98. Under surveillance this morning, some top stories. We'll start with this one. Israeli Prime Minister Benjamin Netanyahu facing growing pressure to accept a ceasefire deal. Hundreds of thousands of Israelis taking part in labour strikes and protests across the country after the bodies of 6 hostages taken by Hamas were found dead in a tunnel in Gaza. Deeply depressing news, AMH, over the weekend, and the pressure really ramping up on the Israeli leader.
Absolutely horrific news over the weekend. But now you did have Biden meeting with his national security team and those negotiators that are working with Qatar and Egypt to try to get this deal done. Biden confirmed it's very close. The Washington Post over the weekend talked about this idea that the U.S. is going to present this take it or leave it approach. And one U.S. official speaking to the Post said, you can't keep negotiating this. This process has to be called at some point. My question is, given what happened with these hostages murdered in that tunnel, does it make a ceasefire negotiation easier to access now or not? I will note, reading some of the tea leaves, you do have the head of Mossad yesterday in Doha for talks. Potentially that's going to open up a pathway.
There's no good answer here. I mean, that's basically what you're seeing from everybody, that there's no neat or good answer, especially because it looks like the message to the people who are guarding hostages is to shoot them or to kill them if the Israeli soldiers are coming after to arrest them in a military way. So you have a nation in mourning. You have a population that's suffering with the polio vaccinations, trying to stave off mass disease that we thought we had eradicated. And you have a situation where we don't have a sense of who's negotiating with whom, who has support at this point, and what's going to be behind it, because some of the big players, Iran, have been quiet, as well as some of the others.
How close are we to a deal? Here, we were given the impression over the last couple of weeks that we are a lot closer than maybe we had been, say, a month ago. How close are we to a deal?
Well, remember, Amos Hochstein was here just a few weeks ago saying it's now or never. It has to be done. they were talking about this bridging agreement, which really goes back to what Biden proposed at the end of May. Remember when Biden came out and proposed that ceasefire agreement, he said that had Israel's backing. It clearly didn't have all of Israel's backing at the moment, because we probably would have already been there by now. They have been discussing this agreement, this idea of take it or leave it. This has been going on for weeks. We have seen countless trips by Bill Burns, by Secretary of State Antony Blinken, by Brett McGurk from the NSC. It's hard to say where we are now, especially given the horrific events over the weekend.
A story that is firmly on our radar throughout this morning. Any more headlines, we'll bring them to you. Stateside, first world problems. Picture this. Sunday, you've got ABC on. You're waiting for the USC-LSU game. You've got ESPN on. You're in the middle of watching the USP Open. Then just like that, DirecTV customers find out they don't have access. Programming going dark at the start of the college football season and ahead of the final week of the US Open tennis tournament after the pay TV service and Disney failed to come to terms, Lisa, on a new contract.
This is the second year in a row, I believe, that it cut off during the U.S. Open. Did you experience this yesterday?
No, I don't have DirecTV.
Okay, well, this is the issue. Basically, people are saying DirecTV is really annoyed at Disney because they're saying that essentially you can't sort of give people the sense that they're getting these channels and then snap off the best parts of the channels at the key times and say you can't have access to those unless you also pay for this. It's a switch and bait, a bait and switch, whatever. The point being, they're pushing back against this, and Disney's saying we can do what we want, we need money, get over it, and this is what's happening. And so you just wonder how much this is going to keep going on, and at what point are some of these Disney networks, et cetera, going to just bypass some of the cable and just entirely.
So who's got the leverage? Do they need Disney more than Disney needs more than?
I don't know the answer to that. I mean, I think that that's sort of the key question.
I think it depends about your viewers, your subscribers, more than 11 million DirecTV subscribers. What are they asking for? Are they tennis fans? Are they college basketball fans? Or are they political junkies? Because this is also happening ahead of the ABC debate next week.
You'll find that anywhere. You'll find that anywhere. Yeah. Can we say the P word on TV? I would be absolutely.
Yeah.
If I was at the end of that. Yeah.
You'd be what? Go ahead.
Can we say that? I'm not even sure.
Yeah, you can say that. Go ahead.
I'm not going to bother.
Okay.
Everyone knows what I mean.
You're miffed.
Yeah.
Yes, that.
But honestly, I could just say this. It ultimately comes down to how big of a sports fan are you? And aren't you willing to pay for that sports fandom? And that's essentially what Disney's willing to wager.
You'd go somewhere else, won't you? Ultimately. And quickly. I would have done it immediately.
Okay.
I was waiting for a sporting event. I'd sign up for something else straight away.
Really?
Yeah.
Just had a rebellion?
I'd love to know what the numbers look like. We'll catch up with an analyst later and we'll see what that churn will actually look like the longer this goes on. Let's turn to this story. We talked about it. Shocking news out of Germany. Bloomberg reporting that Volkswagen is considering closing factories in Germany for the first time in its 87-year history. The decision coming as the automaker is losing ground in the race to produce electric vehicles. The move would set up a showdown with unions across the country. Bloomberg's Christoph Rohwald joins us now for more. Christoph, welcome to the programme, sir. We'd love your thoughts and sort of big picture if we can take a step back. And unfortunately, we only have a few minutes. I know this could take hours. How did we get here?
Yeah, I think this is basically like a situation that unfortunately has been in the making for several years. I mean, the sort of structural issues that have beleaguered Volkswagen for many, many years have been like well documented. And one of the core points was really the competitiveness of their domestic German operations. And that was like probably not addressed in a sufficiently sort of aggressive and efficient way with the Chinese market growing and with the company doing pretty well elsewhere. But all this has changed in a pretty dramatic fashion, really. The Chinese market really struggling. Volkswagen is losing market share there for several quarters already, and that really sort of like puts the spotlight on their domestic German operations, which have been struggling from like high costs and poor efficiency for many, many years, really.
Christoph, the scary thing for the Europeans is this is not just VW. We had a similar conversation with Stellantis. Their factories are operating well below capacity. The conversation we had with Stellantis, though, regarding Italy, were the Chinese manufacturers looking for a manufacturing base in Europe. Is this going to be a pure shutdown potentially, or would they be open? Would the Germans actually be open to selling some of those factories to a Chinese automaker?
Yeah, I'm not seeing that like they will probably sell like any specific assets or like whole factories to like a foreign manufacturer. What they will probably be trying to do is to sort of like restructure the operations to some degree, that they might be able to like sort of specialize on like different components, different technology, move more into like the software side of things. But nevertheless, the point you make is absolutely right. I mean, the competition in Europe for domestic manufacturers by Chinese rivals, by Tesla first and foremost, that is not something that's going to go away. So they will really need to review pretty dramatic and strategically like really critical decisions in order to be able to regain competitiveness on their home market, really.
I was looking at this data from Just Auto yesterday, and it was talking about how auto sales in Europe are still nearly a fifth lower than pre-pandemic levels. And this really has to do with VW, Stellantis, and Renault all operating still factories at suboptimal levels. What kind of shutdowns could we see, and why is there such laggard demand for cars in Europe?
Yeah, I think that is one point, is the sort of like slow recovering car demand since the pandemic. On the other hand, what you mentioned, that's a super important point, and that's the big issue of overcapacity in the European automotive industry. And that was something that many manufacturers, not just Volkswagen, but you just mentioned Stellantis, the same goes for pretty much all legacy manufacturers, goes that they've been struggling really big time to reduce this overcapacity, partly because of political pressure as well. It's, of course, deeply unpopular when you try to cut jobs and close down factories in your market. That's specifically an issue for Volkswagen, where the German state of Lower Saxony is the second biggest shareholder with a 20% stake. So any sort of move to cut down capacity by Volkswagen will definitely face some fierce resistance. And that's a quite similar situation with other manufacturers in Europe as well, given the French ones, Renault, PSA or Fiat that you just mentioned in Italy. Like the political resistance, that's quite pronounced in each and every like European country.
Christoph, that's where I wanted to ask you, the fact that workers occupy half the seats on the supervisory board. So anything Volkswagen wants to do, potentially following in the footsteps of Stellantis and cutting costs, how can they actually go about that?
They will, in some way, shape or form, need to find a consensus with the worker representatives, with the labor unions, and that's going to be really, really difficult because, as Jonathan mentioned already, I mean, the measures that they mapped out yesterday include some pretty painful cutbacks. But they will have to come to a compromise. And having said that, with all the negative headlines out there, this is not the first time that the company has like faced a pretty substantial crisis. They have been there in the mid of the 90s. They have been there in 2005, 2006, and that was something where under like this really fierce competitive pressure, at the end of the day, the unions, the key stakeholders, and management were able to come to an agreement and to like form like a joint plan forward to really move, in this case, the company out of this pretty dramatic crisis situation.
Christoph, I wanted to share the words of the VW CEO with our audience. I know you're familiar with them. The economic environment has become even tougher and new players are pushing into Europe. It's this line that stood out for me. Germany as a business location is falling further behind in terms of competitiveness. For such a long time now, Christoph, particularly in the Eurozone debt crisis, Germany was seen as the bastion of economic stability. It was meant to be the thing that Southern Europe was trying to replicate, wanted to become as it grew older. And Christoph, where are we with the German economic model? How did we come to this place? I guess we're going to finish where we started. To hear these words from the VW CEO, Germany as a business location is falling further behind in terms of competitiveness. What is the government actually doing to tackle this?
Yeah, I think what we've seen regarding the German economy is a bit of a perfect storm. There are multiple factors there, and all like coinciding. Basically, after the energy crunch that was triggered by Russia's invasion of Ukraine, energy crisis shot up big time. There have been like a big issue in Germany before, a pretty significant cost factor, and that was something where like the energy supply of German industry has really become a lot more expensive. That's something where regulators, where the government really struggled to react, and that's still having a pretty pronounced impact. At the same time, Germany in particular has also really struggled to reduce bureaucracy and red tape. It's incredibly difficult to found a company, to establish a company, and to operate a company. There are lots of different rules, lots of different regulations, and that is something that has been criticized for a very, very long time, but very few people really took action to change that. And all that contributes to like a really difficult market situation that now, as you mentioned, the Volkswagen CEO has pointed out, is a pretty severe lack of competitiveness on an international stage when you compare it to other regions in the world, be it in Asia or the US.
We could talk all morning about this. Christoph, appreciate your time this morning. Thank you very much, sir. Outlining two things. One, the mess we're in, and two, how difficult it will be to actually clean up.
Especially given the fact that this is overcapacity, it's a lack of demand, and it's something structural that's happening. And Artie, I mean, as you were talking, I'm wondering how much does this dynamic of Germany's lackluster growth and its competitive disadvantage have to do with the elections we saw over the weekend, with the first far-right candidate elected going back to World War II? People are looking for change, and that is sort of the struggle that the existing government, Olaf Scholz, has to deal with.
It's certainly going to play a much bigger part in the politics if they have to shut down factories in that country. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The U.S. is laying the groundwork for new sanctions on Venezuelan officials. It's a response to Nicolas Maduro's disputed re-election. Bloomberg has seen documents showing that the Treasury Department is close to announcing 15 individual sanctions on officials accused of undermining the July vote. Venezuela, meanwhile, has ordered the arrest of rival presidential candidate Edmundo Gonzalez for alleged crimes, including forging a public document. Bank of Japan Governor Ueda doubled down that the BOJ will continue to hike rates if the economy and prices perform as expected. Ueda submitted the remarks to a government panel chaired by outgoing Prime Minister Kishida. Around two-thirds of economists surveyed after last month's volatility still see the BOJ moving again by the end of the year. Huawei is preparing to launch new products at an event that takes place just hours after Apple's debut of the iPhone 16. Huawei plans to unveil the world's first commercially ready smartphone that folds twice. That's according to people familiar with its plans. Apple is launching its new family of iPhone handsets and accessories on September 9th. In China, Huawei pushed Apple out of the top 5 device makers in the June quarter. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. More from Danny again in 30 minutes. Up next on the program, pushing ahead to payrolls.
The labor market report is going to be the big one. If we do see signs that things are slowing down too much, slowing down to the point where we might have a slump, I think they are going to be ready to take action.
That conversation up next. The payrolls report just a few days away from New York. Good morning. Live from New York City, welcome to the program. Stocks just a little bit softer. We're negative 0.5% on the S&P, no drama. Yields just about unchanged, 390.73 on a 10-year. And in foreign exchange, the euro weaker, 110.37. Against the dollar, we're negative by a third of 1%. Under surveillance this morning, we're pushing ahead to payrolls.
The labor market report is going to be the big one. If you factor in some sort of bounce back and you get a labor market report that's in the 100,000 range, that's going to sort of say, I think pretty clearly, bit more of a slowdown than we wanted. If we do see signs that things are slowing down too much, slowing down to the point where we might have a slump, I think they are going to be ready to take action.
So here's the latest. Investors are awaiting a slew of jobs data this week that could determine the Fed's path forward. Neil Dutta of Renmag has been saying the Fed is late on cutting rates and he's worried about the labour market. He joins us now. Neil, welcome back to the programme, buddy. I want to start with Friday and ask a question I've already asked this morning, so I'll ask it twice. How bad does that number need to be on Friday to open a door for you to make it your base case? They're going 50.
Well, the way the rest of the street is talking, it sounds like it needs to be pretty weak. But, I think that that's part of the problem, right? Because you're almost talking yourself out of going 50 when the data up to this point are already consistent with 50. So I think, I thought the Fed didn't want to be data point dependent. And that seems like what they're doing right here. So, I don't have a good sense. I mean, I think if you get another uptick in the unemployment rate, it's probably a lock. But, at the same time, we tend to overweight the establishment survey to begin with anyway. So it's hard to know. We'll see how it comes out. But I think even if the number does come in better because, let's say there were some one-off factors in the last month that kind of unwind, what's the overall slope of the data? We already know what that is. It's weaker, right? I mean, if you look at the Conference Board labor differential, which was released last week, consumer attitudes about the labor market are deteriorating, full stop. And consumers tend to spot changes in their local economies before the data. They know when the pink slips are going out. They know when factories are hiring people. They know when there are help wanted signs in their neighborhoods. But the fact that consumers are telling you that the labor market situation is getting worse suggests that there's still probably a pipeline of weakness that's still in front of us with respect to the labor market.
Neil, you mentioned the establishment survey. I just wonder this Friday for you and from the clients you speak to, are you more likely to put more weight on the household survey given the difficulties that we've been having?
Well, I think one of the benefits right now of the household survey relative to the establishment survey is that, it's about revisions. I mean, we just got a fairly significant downward revision to the establishment survey up to March 2024. We sort of knew that was coming, but what does that tell you about whatever the payroll number prints in the coming week? Whatever the number is, it's probably going to be weaker in reality, even irrespective of whatever is published. The good thing about the household survey is that the ratios in the job survey aren't really revised, right? I mean, maybe there are changes to population estimates, but ultimately it's those ratios, the unemployment rate, prime age employment. Those ratios don't really change. So I think there's a signal in the fact that the unemployment rate has been going up for 5 of the last 6 months. It tells you that there's a slackening in the labor market.
Neil, I got to say, there's this question about whether we've overly gotten confident about the soft landing. And I look back at history, and there are only 3 soft landings where the Fed has orchestrated a rate cut coming down from high rates where you haven't seen a recession. That was not the case in 2008, 2001, 1989, 1981, 1980, 1970, 1960, and 1957, even though it looked like it was going to be a soft landing. How confident are you that this time the soft landing thing isn't a head fake?
Well, I think part of what's happened in markets is that we went from pricing in no risk of recession to some risk of recession, and it happened very quickly, which is why we got that sort of hiccup in markets, maybe a month or so ago. I still think soft landing is the overall sort of base case. But I do think that the Fed has a role to play. I mean, when I hear people saying that, well, maybe they should string out a bunch of 25 basis point moves between now and the summer. I think that's kind of ridiculous. I mean, the fact that core inflation is running below 2%, frankly, if you look at it since last summer, we've been below 2% annualized on a monthly basis most of the time, believe it or not. To me, that suggests that they're already too tight. So going 50 on the first go is not a particularly big risk, because we know that they're way above neutral. And if you string out a bunch of 25s, getting back to neutral will take a long time.
Okay.
And that puts the economy at risk in the process, because it would mean that you'd be running a restrictive policy stance in the interim period.
Just quickly here, Neil, does this mean that if the Fed were to cut for 50 basis points, and every analyst that I've read says that probably risk assets would sell off immediately on the knee-jerk reaction of a 50 basis point rate cut, you'd be saying this is the time to go buy?
Absolutely, because it tells you the Fed's trying to get in front of the 8 ball. I mean, there's nothing about the economy that the Fed knows that the rest of us don't. They don't have an edge like that significantly. This is more about them coming to recognize that's something the rest of us already do, namely that the unemployment rate's gone up and that inflation slowed.
Neil Dutta making it easy. Neil Dutta of Renmac. Neil, it's never that easy, but we appreciate your take, sir. Thank you very much. This is complex stuff. It's difficult. Fed's been caught offside a couple of times. I think Neil's argument that he's been making over the last several months, if the 5.5% interest rate was the right policy for last July, what's the right policy for this July, this August, this September? And the argument Neil and others have made, to make it very simple, it's not 5.5%.
And it's substantially lower. It's not just 25 basis points lower. So if you're going to do it, why not just do it? Why sort of dribble it out over time to sort of suggest certain things? If you actually believe it should be substantially lower it. I guess on the flip side, you have to wonder why there still is inflationary pressure in areas like rent and housing, et cetera. And I would love to have Neil back on to talk specifically about housing, which he says is a red flag. At the same time that people are saying if you lower rates, you're only going to get increasing costs and not necessarily that much more volume. So real question here.
We can do that next week, September 11th, CPI in America.
Amen.
We've got to deal with the payrolls report first on Friday. The estimate in our survey, 165. Coming up next, Matt Orton of Raymond James, Henrietta Treyz of Veda Partners, Sucharita Kodali of Forrester, and James Camp of Eagle Asset Management. From New York, the second hour of Bloomberg Surveillance. Up next, you're watching Bloomberg TV.
We don't think this is the point to sort of chase risk, broadening out, more balance, more protection at this point in time.
You're in an environment where the carrying cost of being wrong is extremely high.
It's the perfect time from an active manager perspective to monetize that volatility.
If you get rates down, and that is going to accelerate economic activity, you can buy ahead of that.
That's where investors are really focusing on right now, is how do they position for the thing that we know is coming, which is the Fed delivering its first rate cut.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now on a 3-week winning streak on the S&P 500, on a 4-month winning streak. Your scores look like this, pulling back by 0.5% on the S&P 500, on the Nasdaq down by 0.6, on the Russell, on the small caps we're down by 0.9, coming into a week that looks like this. It ends with payrolls on Friday. It begins with an important data point this morning, ISM manufacturing. And Lisa, this was the beginning of a really big move through early August. ISM manufacturing and the subcomponent employment spooking a lot of people.
Giving a sense that maybe employment was weakening and the labor market was weakening more than people previously expected. This is the concern. How much is the weakness that we're seeing in some peripheral data going to become the dominant force in an otherwise Goldilocks type of scenario? It's the reason why I read note after note over the weekend with a lot of negativity. First of all, September tends to be a crappy month for performance of assets. It has been for the past 4 Septembers for stocks, 7 Septembers for bonds. But there's a larger question of how leveraged is this market to a soft landing that has been elusive in most times last couple of years.
That weakness in early August, I think, prompted this line in Jackson Hole, Wyoming, from Chairman Powell. We do not seek or welcome further cooling in labor market conditions. A question this week, will we get some?
And the Consumer Conference Board, which Neil Dutta was just talking about, the fact that when you look at some of the responses, people are concerned now a little bit more about the labor market. When it comes to the whole Fed debate, Marvin Lowe said, we asked him about this, and he talked about the fact that 50, he's one of those 25 until December, string them out, which Neil Dutta calls ridiculous. But how much does a 50 basis point cut before an election that is on a knife's edge look political? That's my big question.
Let's deal with Neil Dutta's line first of all. We're told they're not data point dependent, but there is one data point on Friday that we think the size of the move on September 18th is dependent on. Seth Carpenter, Morgan Stanley, around or below 100K, 50's on the table. Andrew Honhorst of Citi, he thinks 125 and unemployment staying at 4.3%. 50 is very much a go.
So zooming out, is the Fed actually trying to effectuate certain policy, or is it trying to send a message to markets about the weakness or strength of the U.S. economy? Those are two different things. If they want to effectuate a policy, to Neil Dutta's point, and many of these economists as well, the benchmark rate should be substantially lower than where it is now. That's even according to the Fed's view. So why string it out over time? That's basically Neil Dutta's point. That's ridiculous, because essentially, if you think it should be lower, lower it. At a certain point, if they do lower it, that would send a message to markets that maybe things are worse than they had previously expected. And that's the reason why analyst after analyst expects this to be a negative event for risk assets. That's sort of the balance of risks that the Fed is dealing with, the messaging component of their mandate, along with the actual rate and what is actually appropriate for this economy.
Which is why if you want to get really drunk playing a game, a drinking game, which you probably shouldn't play, but if you wanted to play that, this is the game you would play. Gradual, methodical. Every time you hear those two words from Fed officials, drink. And you'll be drinking a lot based on the speeches we've had over the last month.
Yeah, although interestingly, you would not be drinking if you were listening to Fed Chair Jay Powell. And that is interesting. And people have noticed that. Is the Fed Chair Powell maybe not playing the same drinking game because he would like to go all at once? Interesting that we're going to get some speech, some words from the Fed's Williams on Friday after we get the payrolls report. That, I think, will be really fascinating because maybe they can really message how they plan to interpret that data into the size of the rate cut this
Maybe
month.
you would be drinking. Turns up, spikes the punch bowl. Chairman Powell in Jackson Hole. That's what he did, right?
Party time.
It's party time. That's what it felt like.
Yeah, it's the Fed put. Basically, Emily Rowland will come on.
The Fed put is back, according to Emily Rowland and so many others. Equity futures right now on the S&P 500 negative by 0.5% in the bond market. As Lisa mentioned, quite a run for both stocks and bonds going into what is traditionally a weak month of September. 4 consecutive months of gains for equities, 4 consecutive months of gains for bonds. Yields lower for the last 4 months on a 10-year 390.54. Yields just about unchanged on the session. Coming up on this programme, we'll catch up with Matt Orton of Raymond James as traders prepare for a massive September. Henrietta Treyz of Veda Partners with Kamala Harris calling the union vote, and Sucharita Kodali of Forrester as retailers look to boost consumer spending. We begin with our top story. Stocks nearing record highs ahead of a crucial September for the Federal Reserve. Matt Orton of Raymond James writing, "We cannot rule out some downside as investors digest the aggressive rate-cutting cycle currently priced into the market. But as long as the pattern of higher highs and lower lows remains in place, I would continue to use downside opportunistically." Matt joins us now for more. Matt, last time we spoke, you said we're slowing, we're not breaking. Is there something about Friday that could change your view?
Good morning, John. Great to see you again. And I think Friday is going to be very informative because it'll give us another glimpse into what's happening with the labor market, which I've long maintained is the key to holding the consumer in place and this economy together. So a weak print following the weaker print from July would certainly be more concerning. I don't think it's an all-out cataclysm for the rest of the market because there's still a lot of other pieces that fall into place. But I certainly think if you do get a very weak print, say 125 or less, the Fed will likely cut by 50 basis points. And I think that effect can also help provide some positive signaling. But when I look at the balance of risks, when I look at just how earnings season has come in, I really think the strength of the underlying economy has been largely underappreciated by a lot of market participants. I just spent the past week traveling to meet with clients, and a big portion of their portfolios really hasn't been levered to a lot of risk. And so when I look at where we are right now, I still maintain that even if we get a little bit weaker of a job print, there's still a lot of opportunities to invest in higher quality assets where businesses are generating free cash flow and that I expect to do well regardless of the economic environment.
Matt, I've heard a lot of people say this. A lot of people aren't in the risk market and really have a lot of room to play catch up. And yet the Wall Street Journal put this article out this morning that stock allocations account nearly for 42% of U.S. households' total financial assets. This has fueled more millionaires when it comes to 401k accounts than you've seen ever in records going back decades. How do you square that with this idea that people are not overly invested in risk assets?
You know, Lisa, it's a great point, and I think it just highlights how distorted zero interest rate policy has been to really the entire asset market over the past 14 years. Asset owners have done better than those who haven't. And that's led to a bifurcation across the entire consumer class, which was made a lot worse by the inflationary pressures that we've seen. But what I would say to that is even though asset owners are levered to the overall equity market, when you look at general positioning with respect to cash balances and how those looked relative to 2-3 years ago, positioning to me is still largely neutral, I would say. And when you look at investor sentiment in particular, you know, investors have been fighting this rally tooth and nail that something has to go wrong. We continue to hear about the need for 50 basis point cuts, that the economy is deteriorating more rapidly than we think. Yet corporate earnings are good. Guidance on balance is positive. Corporate margins are still sitting at record highs. And so to me, that means that there's a lot of opportunity for those who want to do their homework and look in the equity market. And that's why I've been encouraging clients to lean into this broadening market. You can still own some of the mega caps and high quality businesses, but look a little bit down market cap for businesses that are throwing off free cash flow, that are higher quality and really under-owned by the market.
How receptive are investors to this message, given the fact that they've done pretty well, that they can sit in cash? I mean, we were just talking last week with people who are saying essentially this idea of $6 trillion that are on the sidelines, the sort of cash on the sidelines is kind of bogus because it's happily there. I mean, it's not going anywhere. How much are people actually moving?
It's such a good point, Lisa, because we also forget that rates aren't going back down to zero. I mean, maybe we'll be back down to 2.5% or 3% or wherever the neutral rate ends up landing. So there's always going to be a reason, I think, for some money to be sitting on the sidelines. But a lot of the conversations I have with our clients are focusing on the opportunity cost of staying in cash versus what they would give up. And a big concern for clients right now is how am I going to match the same yield and not take too much risk? And what's really nice about the market today is that there's a lot of opportunities to not reach far out in the risk spectrum in fixed income, where you can still get a very respectable yield, particularly if we see a backup around some of the offside interest rate pricing heading into the end of the year. And dividend payers are largely under-owned. Valuations are still fair. They're throwing off very respectable rates of cash to investors. And so you have the chance for capital appreciation as well, which you really haven't had that combination of yield plus appreciation in a very long time. And that has been well received by investors.
Matt, before we get to the end of the year, though, we do have an election 9 weeks from today. You're talking to clients. How concerned are they about November 5th?
Yeah, they're very concerned, Anne-Marie. I think I have not had a single conversation where elections has not come up. And that's been around many, many different parts of the country. And I think a big question with respect to the elections is just what is that going to do with respect to taxes? I think there's a lot of entrenched views on one side or the other. And so just understanding the overall market implication, I think becomes more challenged when individuals have such big views. And my main message to these clients, like we talked about last time, is just don't try and play the market based on who you think is going to win. Think about the market in totality, what's going right, and try and find some of those durable secular growth trends that are going to be in place regardless of who wins this election. Take, for example, infrastructure spending. Manufacturing, reshoring, bringing jobs back to the country seems to be a goal of both parties. There's a lot of opportunities in the industrial space that lean into that and also lean into artificial intelligence, like electrical equipment companies, utilities. So there's plenty of ways to play this without being political, and that's where I always try and bring the message home to investors.
Utilities up around 20% in 2024, up almost 7% in July, up more than 4% in August. Matt, how stretched is that trade?
I think it's certainly stretched from a near-term relative perspective, but when you look at what we need to actually realize AI monetization and the data center growth that's being projected, we do not have enough energy in this country, John. And so I've actually been able to talk to some senators and representatives in Congress about what their plans are to make sure there's power, especially across the Sun Belt. And they have told me trillions, with a T, trillions of dollars are going to be spent over the next 3 to 5 years in order to build out the grid. And so you want to find some of the utility companies that are able to provide those electric utilities, but also might be leaned into some of the trends going forward, like sustainability and growth, because that's still going to be the way forward in order to provide enough power. So there's definitely long-term opportunity, but don't chase the trade. Wait for it to come to you should there be a pullback in the market.
Well, it's certainly a popular trade. P for popular, Matt. Very popular. Matt Orton of Raymond James. Thank you, sir. Appreciate it. Equity futures right now negative by 0.6% with an update on stories elsewhere. Here's your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Dissatisfaction with housing costs has hit a record high in rich countries, according to the FT. Citing a Gallup's analytics poll, half of respondents in OECD nations are unhappy with the availability of affordable housing. In the U.S., that figure is almost 60%. Researchers partially blamed a lack of construction for the affordability crisis. Tesla shipments from its Shanghai factory rose for a second straight month in August. Prelim data from China's Passenger Car Association shows Tesla shipped over 86,000 Model 3 sedans and Model Y SUVs. That's up roughly 3% from a year ago, some new momentum after a first-half slowdown. Huawei is preparing to launch new products at an event that will take place just hours after Apple's debut of its iPhone 16 on September 9th. Huawei plans to unveil the world's first commercially ready smartphone that folds twice, according to a person familiar with its plans. In China, Huawei pushed Apple out of the top 5 of device makers in the June quarter. And that's your brief, John.
Danny, thank you. Before we work out whether we need it to fold twice, do we need it to fold once? Have we actually demonstrated that this is something people need?
I spent some considerable time watching videos of the folding. And there's a theory around the folding. There are a couple theories. Number one is you could actually drop it and it won't hurt the phone as much if you drop it on the right side.
Right.
And then there's the other issue of you can get more screen space, so you could fold it out. And then there's the third way of it just looks really cool and modern.
Isn't it just becoming a laptop?
Essentially, but isn't that what you use it for?
I wonder if it helps with butt dialing, because it's folded and it's not just in your pocket.
Oh, you have those problems?
I still have those problems.
Okay.
Really? You're a butt dialer?
Don't you just hold the... Oh, right, okay. Up next on the programme, on a campaign trail, it's America First.
It is vital for our nation to maintain strong American steel companies. U.S. Steel should remain American-owned and American-operated.
That conversation just around the corner, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
A beautiful summer's morning in New York City. Good morning. Equity futures negative by 0.5%. I can hear TK. It's un-American.
Okay.
Yields are unchanged on a 10-year, 390.
It's just not accurate. That's just not, okay, I guess it is technically until September 21st, but come on.
By definition, it is accurate,
Okay,
actually.
is this basically your calling card for this particular cycle?
I'm just trolling people who really care. I don't care that much.
Make summer great again.
I really don't care that much. Make September great again. September scary is a real thing for a lot of people. The anxiety of winter just being around the corner.
It's my birthday month. September is a wonderful month, naturally.
Happy birthday, Bramo.
Thank you. Well, it's not for a while.
This is like the promo for Bramo's birthday. An early promo. All right. Under surveillance this morning, on the campaign trail, it's America First.
It is vital for our nation to maintain strong American steel companies, and I couldn't agree more with President Biden. U.S. Steel should remain American-owned and American-operated. And I will always have the back of America's steelworkers.
So here's the latest. Kamala Harris aligning with Joe Biden and her opponent Donald Trump in opposing the proposed takeover of U.S. Steel by Japan's Nippon Steel. Harris catering to the union vote over Labor Day weekend, just 1 week shy of the first presidential debate set to air on ABC. Henrietta Treyz of Veda Partners writing, Harris is ahead in the polling nationally, but the Electoral College remains extremely tight and continues to favour Trump and the Republican Party, in our view. Henrietta joins us now for more. Henrietta, welcome back. We'll turn to the polling in just a moment. I want to start with the steel issue first of all. On this issue, is there any daylight whatsoever between the two candidates?
There's no daylight between the two candidates, and frankly, there really can't be. I have some really fantastic clients who were asking this question a year ago. Where are the presidential candidates going to be on the X versus Nippon Steel deal? And the answer is effectively they're going to say they're against it for the duration of this election cycle. If anything, you should expect for none of this to be concluded until after the election. There's no reason for a rush, and there's no other alternative for any presidential candidate. The alternative of saying, yes, I think Japan should come in and buy one of the most, American brand companies in the Rust Belt before an election cycle is sort of unthinkable. So this should have been well understood and predicted many months ago, if not a year ago.
Henrietta, though, this time next year or January 21st after the inauguration, if one of these individuals becomes inaugurated and then backtracks, how is that going to affect them in the future?
Well, I think what you need to think about is that the regulatory agencies have the option to go in and study the issue, whether it's DOJ or some of the other administration agencies, go in and say, look, what are the cost benefits here? And then either give it its blessing or not. During that interim, they're going to have to go a long way towards giving the unions what they need to the point where they get unions on board. That's the only way that this progresses. So the burden and the onus is really on the company, on Nippon Steel, to make sure that the unions are behind them. And once that occurs, then you have a situation where the deal can go proceed, but it's never going to be, you have my blessing. It's either going to be, there haven't been enough issues to derail this, or proceed in, the free market society that we live in.
Henrietta, in Pennsylvania, Kamala Harris said, let's not pay too much attention to those polls. You are one individual that thinks Trump has the edge when it comes to the swing states. In Pennsylvania specifically, why do you think he has that edge, even though she is doing the work there and going to places like Beaver County?
Pennsylvania has slowly become more and more Republican leaning, and a big part of my bias towards Biden in that state early in the year was mostly because he's Scranton Joe. He was, raised in the state, and I think that carries a lot of weight. Kamala Harris is deploying Joe Biden in that area, and I think Tim Walz goes a long way towards speaking to that demographic. But it's an issue where we see the unions play out, where the top of the union structure, for example, has strong support for Kamala Harris as the Democratic candidate who has, minimum wage issues in mind and is fighting for unions. Joe Biden famously went on the picket line. Kamala Harris has been on the picket line. But then you have the members themselves of, the million-person strong Teamsters Union, for example, who are very conflicted, and they personally support Donald Trump and his brand of politics. So I think it's a harsh disparity between people at the top of the unions and then their rank and file members who may prefer to vote a different direction. And it's slowly been trending more and more red, getting closer to Ohio, which consistently has voted for Trump +8, +9, and is now +12 in that state, which is just right next door.
Trending red, especially in Western Pennsylvania, but it has a very popular Democratic governor. Does that not favor Harris?
It does have a very popular governor, and that's great. And I think Shapiro has been an exemplary speaker on the trail. His speech at the DNC was notable in terms of getting support, but you really have to just keep that trajectory open. What the Harris campaign is trying to do right now is turn out youth voters. We saw a 178% voter registration uptick amongst Black women in America in the last 3 weeks or 5 weeks since Kamala Harris has been the campaign frontrunner. We saw a 148% increase in Latino females in registering to vote in the United States. So it's all about voter turnout in these high urban density areas where Kamala Harris is going to try to run up the numbers and get it on par with 2008 with Barack Obama, who won the state overwhelmingly. So that's the trajectory that they're trying to pursue. And you're not going to see that translate into the polls. For reference, all these new voter registrations, those are not going to be taken up in the polls because pollsters are not reaching those new voters. So they also have a higher propensity to vote than somebody who's been on the rolls for years or decades. So I think that there could be a sleeper voter in Pennsylvania and other states nationwide, which is these new registrants that Kamala Harris has turned on in the last couple of weeks.
When you look at the polls, Henrietta, what's the main campaign issue of this campaign cycle?
Right now, it's immigration and abortion. Those are the two top issues. When you look at voters and they say it's the economy or inflation, those are no longer reliable data sets because they skew partisan one way or the other. If you like Donald Trump, you think the economy is trash and we're going to a recession. If you like Joe Biden or Kamala Harris, you think the economy is improving. You feel good about your own personal finances. You feel good about your state's personal finances. And you feel like the inflation issue is coming down, which it is at 2.9%. I think that the Federal Reserve lowering interest rates in a couple of weeks is going to be really powerful for that message as well. But you keep having these upticks and fears about recession that keep being unproven and unmerited. And that is something that needs to resonate with the American voter, but they don't receive that information due to partisan leanings. As a result, the most reliable data that you can look at as an investor watching the polling is where do you stand on immigration and where do you stand on abortion? And that's really what's driving the gender divide, which is outrageous. It's so big this year. It really is becoming men versus women in this election cycle.
So let's put abortion aside for 1 second. With immigration, what is the daylight between people who are for much more stringent types of rules and those who would like to see a more measured approach? I mean, how much is this really dividing between Republicans and Democrats? And how much is there really room to negotiate?
It's interesting. There's not really that much of a divide. Democrats have come very far to the right in their latest bill that was rejected by Republicans in the early part of this year at the request of Donald Trump to say, let's keep this issue front of mind. But Joe Biden has introduced and signed some of the most extreme executive orders that have more than halved illegal immigration since the beginning of this year. And we're now down to pre-2020 levels when he took office. So I think that the Democratic Party has gone far to the right on this issue. It's really a question of whether voters are prioritizing immigration or not. Everybody is pretty much in favor of increasing drones at the southern border, boots on the ground, expanding, judges in the area, having a more streamlined asylum process so we can process illegal immigrants more quickly, and certainly compelling Mexico and southern border country nations to improve economic situations in their region so that they do not have this surge of immigration at the U.S.-Mexico border. So I think it's really about who talks about it in what kind of a way, as opposed to what functionally do we want to see.
2 months to go. Henrietta, thank you. Henrietta Treyz of Veda Partners. The countdown to the US election continues. Coming up next on the program, retailers looking to get a jump on holiday spending. That conversation just around the corner. Max Kettner, HSBC, with this to say. High-frequency data have improved. Jackson Hole brought the Fed put back with a vengeance. We remain overweight equities. The bull is still bullish. Equities right now negative 0.5% following a third week of gains on the S&P and a fourth consecutive monthly advance on the S&P 500. Putting back just a touch on the Nasdaq with negative 0.7, but outperforming the equal weight on the S&P 500. Just stripping out the muscle of big tech is where some of the bigger gains have been.
Yeah, for 2 straight months. And the interesting thing about Max Kettner is that his bullishness was really idiosyncratic, I would say, compared to some of the other notes, basically saying the Fed put could also spark a rally in, quote, junk assets, such as U.S. small caps in the coming weeks and months. Other people disagreeing. I mean, Mike Wilson has been sort of on this train for a while, talking about how they're not going to outperform. It doesn't make sense. But others, I mean, Stuart Kaiser, that was a notable shift for him as well, talking about downside risk, especially if bad news is bad news and we do get that downside surprise.
Mike Wilson teed up the potential of maybe a repeat of August 2nd if we get a bad number. When we last spoke to him, not saying a perfect repeat of August 2nd, but something similar. Bad news is bad news.
Which we have seen kind of bleed into markets, and you can kind of see a precursor. I mean, today's action, you can't really derive too much from it, but you can see the underperformance coming from, guess what, small caps. There is this fear being baked into markets that maybe we have overestimated the chance of that soft landing, and that might be the trade to unwind. We'll see. I mean, that's the argument that Mike Wilson is making.
Let's turn to the rates market. Front end of the curve, the 2-year will sit there, 393.32. 4 straight months of yields declining at the front end of the curve, down by more than 30 in the last month or so. Teeing things up on Friday, really a conversation about whether they go 25 or 50. I mentioned Andrew Honhorst of Citi. This is his note this morning. If we get 4.3% and 125 on payrolls, that means for them, the Fed goes 50. A drop in the unemployment rate back to 4.2, and they think maybe the Fed just cuts 25. So I know we've said this a few times now. The Fed says they're not data point dependent, but for basically Wall Street, the difference between 25 and 50 is whatever Friday brings.
When you take Andrew Hollenhorst and then you take Neil Dutta and you put it together, put both of those views together, what I get is focus more on the actual unemployment rate and maybe not on the headline number, basically to understand exactly where this dynamic is. Basically, we're talking about the Sahm rule that Claudia Sahm has shifted herself away from as being sort of declarative, as still being front and focus. If we really do get that sticking, that's going to really make the difference.
I wonder also if economists are willing to put a bit more weight on a household survey versus the establishment survey, given the revisions we've seen over the last 12 months. You mentioned this last week. I had this question this morning from a viewer who turned around and said, are we going to put more weight on the ADP report? And never mind non-farm payrolls. And I joked whether people would be willing to just chop 60, 70K off whatever the number is on Friday.
Yeah, because essentially that's what the revisions have done. Some people have taken a look at the ADP survey of private payrolls as being more instructive than the overall survey, even though it purports to not even be predictive of the survey that we get on Friday. All this goes to show people doubt the data. And this is one of the conundrums that the Federal Reserve faces when they're data point dependent. If this is really going to make the difference about whether 50 basis points or 25 basis points, and it might be revised out of relevance in 3 months, what are we doing? And I think that was sort of the point that Neil Dutta was making.
Isn't that what we're all asking every single morning? What are we doing?
Make summer
what
great
are
again.
we doing? We've got plenty of time to talk about this throughout this morning and throughout the week. I want to finish on the commodity market. Copper down by 2.3%. Huge revision over at Goldman Sachs, led by Dan Stuyven, who's come out with this call on copper. The call was 15,000 a tonne. That was the target for next year. Lisa, it's now a little north of 10K. That is a big, big revision.
Yes, this is a question about whether it's a massive overhaul of the view just more broadly, or whether it's also a sort of a changing of the guards at Goldman and sort of a revising of the overall outlook at a time when maybe the super cycle in commodities isn't happening as quickly as people previously believed. The heart of this is just basically China. It's slowing a lot. It's unclear how people can really get out from under that. And frankly, the data over the past couple of days just confirmed that.
Weaker demand. That's the latest on copper. I actually want to sit on crude just for a beat longer. I think a really important development over the weekend was on the White House X account when they tweeted the following: oil production has hit record highs under our administration. Now, for anyone following this over the last few years, this has been the story. And Republicans have been able to come out and say oil production is being held back by Democrats because Democrats have been unwilling to come out and say, actually, that's not the case, because oil production has been at record highs. And you have to think about why. And the why is really quite obvious. Progressives are unhappy with some of this. Now, I think what's interesting about this moment in US politics, particularly for the Democrats, a key pillar of momentum for Kamala Harris has been the unwillingness of progressives to pin her down on unpopular issues on the national stage. And it is interesting to me that the White House feels confident enough to come out and now address this head on. And just right, oil production has hit record highs under our administration while we also continue to accelerate our transition to clean energy. Are they finally going to start making the point that a lot of people have been asking for a long, long time?
They shored up the base. Where was she this weekend? Pittsburgh and Detroit. They are going after individuals that care about the future of the energy sector, base metals, oil and gas in this country. And this is an obvious shift to the center 9 weeks ahead of the election.
It's a huge shift, particularly for the leader of that campaign now, given her previous views 4 or 5 years ago.
She has the privilege of catering to the center because she didn't have a primary. And that is essentially what we're seeing. And the question is whether it's actually representative of how she will govern if she is elected.
Certainly how they're campaigning, and it's turning out to be a huge advantage. Under surveillance this morning, a top story for you in the FX market. Bank of Japan Governor Ueda repeating the central bank will continue to raise rates based on the economic outlook. Ueda submitting the comments to outgoing Prime Minister Kishida. About 2/3 of economists surveyed by Bloomberg still see the BOJ hiking again by the end of the year. In foreign exchange, a stronger Japanese yen. Lisa, dollar yen down at 146.
Yeah, and you asked a good question earlier, just how much more momentum is there behind some sort of strength in the yen? How much of an overweight is there still in the dollar-heavy trade that we saw for the better part of the past 2 years? And that ultimately is what we heard from Kit Jukes of Societe Generale. He was talking about the record purchases of U.S. bonds and equities. This isn't just an FX trade.
No.
This is an unhedged U.S. asset, U.S. exceptionalism trade. Is this something that is poised to be unwound and is just a little bit of softness in the dollar, the best case scenario, and that's basically what he's looking for?
How painful might that be for equities? We'll see. Let's turn to this story, the latest out of Venezuela. The United States laying the groundwork for new sanctions on government officials in the country. Bloomberg reporting the Treasury Department is set to sanction 15 people affiliated with leader Nicolas Maduro, accusing them of obstructing the holding of free and fair elections. Just compare and contrast where we are now to where we were 12 months ago, when there was a real conversation about easing sanctions even further on Venezuela. Then things started to change a number of months ago.
And part of that also had to do with the energy story, right? And making sure that you can keep oil prices and thus gas prices in check, especially in an election year. This comes a month after that election authority said that Maduro had won, but the electoral data by the opposition suggested otherwise. Also, what did we see over the weekend before these sanctions are about to be rolled out? DOJ puts out a press release that they actually seized a plane that they said Maduro has been using, coming from the United States, $13 million purchased through a shell company and smuggled. How do you smuggle a plane out of the United States? That's my question.
Yeah, I've got the same question, actually. I've also got a question for foreign policy in the State Department. Carrot versus the stick. They tried the carrot and it failed. Are they going to start using the stick more?
That's what it looks like when they're laying the groundwork for these types of sanctions. To your point, carrot didn't work. Now here comes the stick, and they're already doing it. Yes, the sanctions are being rolled out, but they're also starting to do things like seize jets.
That's the latest on Venezuela. The latest on Cathay Pacific Airways, cancelling some flights due to new inspections of its Airbus A350 fleet. The airline are focusing on deformed or degraded fuel lines for the Rolls-Royce-made engines. No other airline has come forward with similar issues. What do you make of that, Lisa?
Well, I make that this is a story because everyone's looking for problems with planes. I mean, how often do we talk about problems with planes since what happened with Boeing? And is that basically what we're looking for? On the flip side, how much are some of the industrial production snafus that we're seeing with Rolls-Royce and Boeing related to leftover pandemic supply chain issues and also the workforce and what happened there? Those were my two takeaways.
Let's hope it's isolated to this very, very specific issue. The latest on retailers looking ahead to the holidays with summer coming to a close. Sucharita Kodali at Forrester saying this: the companies that seem to be winning are Amazon and Walmart. We already know that retailers are planning to promote more this fourth quarter. Sucharita joins us now for more. Sucharita, welcome to the programme. Let's talk about back-to-school shopping first of all. How strong have things been over the last couple of days? What do your channel checks look like?
Well, the challenge is that the National Retail Federation a couple of months ago predicted that it would be the second highest back-to-school season ever. But the underlying thesis there, the underlying story, is that the numbers are not up. When you're the second highest, that means that last year was the highest. This year is down from last year. So that's really not a great thing for the retail industry. And I think that it really is pointing to the shopper is just sick of the levels of inflation, and they are pulling back on a lot of things, including these essential goods for their children during the holiday season.
They started planning for the holiday season a long, long time ago, as you know, Sucharita. And we all know, based on the calendar, Thanksgiving comes late. The holiday shopping season is shorter. They've got experience of dealing with this. How do they address issues like that?
Promotions, that's really what it comes down to. And what you have is just more promotions, deeper promotions, promotions across a greater number of items. And you see that consistently over and over again. And I expect that to be in big numbers this year, too. There was a little bit of a reprieve in 2022 because of supply chain issues, and retailers felt that they could raise prices without necessarily having to discount as much. But it seems like we're back to those 2018, 2019 promotional levels. You also have Amazon coming in with 2 promotional vehicles annually, which is a big deal because it's pulling forward things like sales for back to school. It's pulling forward shopping for the holiday season because people are shopping in October, not November.
You said something in your notes that really struck me. You said Labor Day isn't usually a huge weekend, except maybe for some back to school offers, but most of that shopping is accomplished before September 1st. I was thinking about that yesterday as I was frantically on Amazon ordering note cards and binders and things that I had been negligent about earlier. So, Trey, you say that everybody is so organized and they're all out there shopping for it, or is everybody on Amazon at the last minute trying to get all those supplies that you need to provide for your kids heading to their first day of school?
Well, there are definitely a lot of people shopping on Amazon. When we see Amazon's numbers, that is pretty clear. But there are also a lot of people shopping at the stationery and the office supply stores like Staples, certainly Walmart, Target, Costco. They are all beneficiaries of this time period, too. But when we look at surveys, when we look at numbers, people do actually do a lot of shopping in August. Some people are very organized and do get it together in July. And the truth is, a lot of schools are already open. So it doesn't make sense to be shopping for things like clothing and electronics after the school year has already started.
Sucharita, I've got to say, the retail earnings were kind of all over the place. And I'm wondering what your takeaway was. You were talking about a more discerning consumer and potentially some pushback with respect to inflation. Do you get the sense that this is one pinpoint on a downward trajectory, or is this sort of the trough that you see with a greater propensity to spend later in the year?
Well, when we look at those numbers being all over the board, really the positive numbers are Walmart and Amazon, and a number of other retailers have really been challenged this past year. Even Lululemon, which had historically been doing really well with double-digit year-over-year growth, has experienced single digits. Which these are sort of canaries in the coal mine that the rest of the outlook for retail for the rest of 2024 may not be so strong. When will it recover? I do think that as interest rates go down, which will likely be through, of course, the rest of this year, 2025, we may see some rebound. But the truth is that retailers don't have a lot of pricing power right now. So they have to be much, much more cautious about how they are charging shoppers. And shoppers are shopping around. They are looking for everything from secondhand goods to bargains wherever they can find them.
Sucharita, one thing I noticed last week, whether it's at the checkout counter, they were selling candy corn, or going through some of the aisles and they already had Halloween candy and costumes and lights up, and it wasn't even Labor Day. Is that a trend that these holidays are being brought forward even earlier than usual?
Yeah, and it may seem like it's earlier than usual, but the truth is that this is a trend that's been going on for years now. It is not unusual to have the setup of Halloween happening as early as late August, and certainly, definitely through September. Retailers are dependent on seasonal items because it drives people into the store and it gets them actually there for a couple of purchases. And then ultimately, especially if you're a mass merchant with lots of categories, you probably had the experience of, walking out of the store with hundreds of dollars worth of goods. So that ends up being standard. We'll likely start to see holiday promotions as well, probably as early as September. Everybody, kind of thinks that they are behind if they don't. And certainly with Amazon having another Prime Day deal offer set in October, that's absolutely going to promote for the rest of the industry as well.
Starbucks loves it, don't they? You notice that, Bramo?
Okay.
Signs go in the window in the middle of August.
You try to tweak me? You try to get me excited about this?
You get excited about that?
About what? Fall and pumpkin drinks?
Yeah.
Oh, yeah. I'm a big pumpkin latte person.
Didn't know that.
No, I'm not a big pumpkin latte person. I'm not somebody who goes out with hundreds of dollars.
This morning.
No, I mean, look, yeah, I know you're a big Halloween person. Big.
Really into it.
Yeah. Lots of candy corns.
Let me thank our guest, Sucharita Kodali of Forrester. Thanks for joining us this morning. Huge Halloween kind of guy.
Oh, yeah, big time.
Huge, massive.
You should see on his door, massive skeleton, plastic skeleton, kind of hanging down there with glow.
They're just throwing out candy for the kids. The end of October.
You're the person who hands out.
Super into my community into the city.
He puts all the lights off on Halloween. Don't come here.
That's who I am.
I know.
Lights off, don't come in,
and
don't
if they
knock the
come
door.
in, you give them 3 pennies and a thing of cut fruit.
Yes. Berries. Some sliced apple.
That's actually
expensive.
Yeah. They're good gifts. I didn't say I was cheap.
It's like, kids, stop rotting your teeth.
Let's give you an update on stories elsewhere this morning. Apples will do that too. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Airbnb is lobbying New York City officials to scale back a local regulation that outlaws most of its short-term rentals. In a blog post this morning, Airbnb said the regulation hasn't stopped the rise in NYC rents. Instead, it's just left travelers without affordable accommodation, priced out by record-high hotel rates. The rule came into effect nearly a year ago. The city has yet to signal a willingness to amend the law. Goldman Sachs has slashed its forecast for copper by almost $5,000. The bank had been one of the biggest cheerleaders of the metal, but analysts writing in a note that sluggish Chinese demand will delay an expected rally. Goldman expects prices to average about $10,000 next year. Its previous target, set by former analyst Jeff Curry, was $15,000 a ton. Fans of Oasis are looking back in anger at Ticketmaster, with prices skyrocketing for the group's hugely anticipated reunion tour. Ticketmaster is using dynamic pricing to set rates, adjusting based on real-time demand. Basic standing tickets were initially advertised at around £150, but rose to $350 after a few hours as fans rushed to the ticketing websites. And that's your brief, John.
Danny, thank you. I know it's all relative. It's always all relative. But relative to the experience of getting Taylor Swift tickets, I think Oasis fans did all right, didn't they, over the weekend? $350 versus $150 versus stories of thousands and thousands of dollars stateside.
Were you able to resell these, though, at $10,000, $20,000?
Face value, you can't.
So that's the reason why.
Has to be face value, yeah.
Well, Deutsche Bank's Rick Reed are struggling, according to his note.
Who's that? Jim Reed?
Yeah.
Rick Reed is BlackRock.
Sorry, that's right.
All right, let's get our people right. Up next on the programme. Dear me, the Fed's next big catalyst.
You know, from a risk management standpoint, you have to start pushing rates a little bit lower, gradually, but you're over tight. So the direction of travel, I think, is what matters to the Fed, not necessarily every single data point.
That conversation up next. You're watching Bloomberg TV. Pause. Yes. No. You don't get to drop that in.
No, let's just move this on.
Seconds before we come back. I was in the Halloween Day Parade in the Village once. Okay. How old were you?
I was 16.
What did you dress as?
I guess cowgirl. It didn't matter. We just got in there.
Do we have photos?
Yeah, let's just move on. Come on, let's talk about the Federal Reserve.
I will move on, but I want to see pictures of this. Equity futures on the S&P. Negative by 0.5. Yields up by a single basis point on a 10-year, 391.68. Mislav Matejka of JP Morgan. Still somewhat cautious here. Sentiment and positioning indicators look far from attractive. Political and geopolitical uncertainty is elevated, and seasonals are more challenging again in September. The latest view from JP Morgan. Under surveillance this morning, the Fed's next big catalyst.
What you're seeing is mission accomplished on inflation, or something very close to there. And now you're worried about the unemployment rate. And if that continues to drift higher, you know from a risk management standpoint, you have to start pushing rates a little bit lower. Gradually, but you're over tight. So the direction of travel, I think, is what matters to the Fed, not necessarily every single data point.
Here's the latest. Markets looking ahead to Friday's payrolls data. The estimate in our survey sitting at 165K. Investors hoping the data will confirm the widely expected Fed rate cut in just over 2 weeks. James Camp of Eagle Asset Management with this to say. If Fed officials want to avoid a recession, they might as well make a more meaningful cut, i.e. 50 basis points or more, since the inflationary backdrop for additional cuts may diminish by the end of the year. James Camp joins us now for more. James, let's talk about the end of the year. Let's skip the short term and get to the interesting part. Q4, do you have inflation picking back up?
Yeah, John, we do. We've got a couple of things. One is base effects, which we've talked about quite a bit. The second, owner's equivalent rent is going to tick back up. The seasonals are also not favorable for inflation. So our modeling tells us that we're going to get back to what I call a post-COVID normal 3.25% inflation rate. We actually think that's where inflation settles out long term in the new economy.
You think that that's actually important for the Fed to do in order to keep this rally going. Isn't that right, James?
I do. I think one of the things that they're going to have to look at is how much runway do they have after the seasonals pick back up in inflation. And this is really one of the most interesting times, Lisa, I've seen for the Fed, because there's such a confluence of different things. And I think the real crux of it is we are just in a different economy. And I think the core inflation rate is going to be more the pre-financial crisis era with the 3.25%. And the other part of, I think, what the Fed has to look at is we're not getting any help from the fiscal side. We're not likely to get help from the fiscal side into 2025 in terms of deficits. And deficits are an inflationary impulse as well. So the Fed's going to have to settle in with a longer-term inflation rate higher than 2.
If the Fed does not tacitly acknowledge or even verbally acknowledge that they are going to accept an inflation rate above 2%, does that indicate to you that they're going to be late to the game and not cut rates enough?
I think it means that they're going to have a terminal rate higher than the market wants. I mean, the market has been cheerleading for Fed cuts all the way back to the end of last year. I think we had 8 priced in as we started 2024. Our base scenario has us with a terminal funds rate still with a 3.5 handle. So the suggestion that the Fed is going to change and cut in September is likely, but the extrapolation into a real aggressive sort of back to the post-financial crisis normal of ultra low rates, I don't think is in the offing at all.
James, how easy do you think it will be to get the committee together and pointing in one direction when they come together, I think September 17th before the decision on the 18th?
What's interesting, John, about the Fed, the Powell Fed, is there's always been a unanimous vote. I actually don't like that. I'd like to see dissent, and I'd like to see the actual 8-4 or whatnot. But yes, he's going to have to get consensus, and the likelihood that he can coalesce around 50 is probably not likely. But I still think that would be the preferred policy response, at least at this point.
James, how do you think, and this is just pure scenario analysis, of course, and I don't know if this is your base case or not, how do you think the market would trade on dissent, given that we're used to anything but?
Well, I think it would be a unique thing for this Federal Reserve, but it's not historically. I mean, we typically do have more give and take, and we do have more sort of insight into some of the disparate comments within the Fed. What we see instead is some of the Fed speak, after the meeting, and we have sort of surrogates, ex-Fed governors, et cetera, sort of doing that heavy lifting. But Powell has been very much a consensus type Fed chairman, and I think we will probably see that again September 18th.
James, just real quick here, how much then are you betting on a steepening curve, that essentially the Fed is going to cut rates and that's going to allow long end yields to climb, because that's essentially going to imply a higher inflation rate over the long term?
At least I think that's exactly where we're going. We're back to where we ended last year in terms of the 10-year yield. I think 10 years are overbought here. I think the inflationary backdrop is going to be suggestive of a more positive yield curve. And that actually may be okay. That may be helpful for the banking system. It may be helpful for some of the funding mechanisms of the deficit, et cetera. But I do expect at some point, and we've got 2s to 10s close to uninverted here. I do think at some point in 2025, we see slope in the yield curve again.
There's only a basis point or two in it right now. James, appreciate your time, sir. James Camp there of Eagle Asset Management. James, thank you, sir, with an interesting view on the end of this year, Q4, inflation picking back up.
Yeah, and this is something that other people have talked about. But the interesting aspect of this view is that doesn't mean that the Fed shouldn't cut rates and maybe even cut rates significantly, but that the Fed has to come out and basically say, look, we are in a more inflationary world, but we can't torpedo the labor market as a result of the additional inflation. We just have to accept it, and that is new.
The third hour of Bloomberg Surveillance just around the corner. Here's your lineup. Kevin Gordon of Charles Schwab, Matthew Dolgin of Morningstar, Greg Daco of EY, and Brent Schutte of Northwestern Mutual. From New York, that's all coming up next. This is Bloomberg.
We're at an inflection point, and it becomes difficult to know, are you moderating into a soft landing, or are you moderating and then slowing down much more sharply?
We should expect to see over the next several months probably still some more softening in the labor market.
On average, the consumer's doing fine, but there are pockets of weakness here. And I think the Fed has to be attentive to that.
The consumer's searching for value because they don't have the stimulus dollars they had a couple years ago.
We do think that what's on the horizon is the risk that inflation actually picks back up again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Welcome to September, live from New York City. Welcome to the third hour of Bloomberg Surveillance. Good morning to you all. And let's begin with the scores. On the S&P 500, negative by 0.5%, pulling back and just chipping away at a 3-week winning streak on the S&P 500. On the Nasdaq 100, down by 0.7. On the small caps, the Russell, down by 0.9. The data this week, there's a lot of it, so let's go through it together. It kicks off a little bit later this morning at 10 a.m. Eastern Time with the ISM manufacturing. We'll get jolts through the week. We'll get jobless claims, an ADP report. We'll get another ISM and an August jobs report. Lisa, I think pretty much everything comes this week.
And it comes with this drumbeat of a question. Are we seeing true weakness in the economy, or is this a strong economy that can afford a sort of soft cutting cycle from the Federal Reserve? This ultimately is the key question. It's no longer about inflation. It's about, is bad news with a labor market that can really rectify some of the questions that came from with last month's labor market report.
And what is bad? What is bad news? Bad relative to expectations, bad relative to the trend? Because right now we're looking for 165. 165 doesn't sound too bad.
It doesn't, but it is lower than the trend. And it does come at a time where revisions tend to be 60 or 70,000 lower when you look back on it. So at what point are we looking at the actual headline number? And this is something that Neil Dutta raised. How much are we looking at actually the unemployment rate? The idea of what kind of slack do we have in the economy? How many people are exiting the labor market? There are some real questions about what a number is that's good or bad if you have an employment base that's actually increasing to the degree that it is.
Well, let's run with this. Let's pick out a bank that's looking for a 50 basis point cut on September 18th. And the difference between going 50 and going 25 is 0.1% on unemployment. If we stay at 4.3, Andrew Honhorst and the team over at Citi believe that they go 50. If we come down to 4.2, he thinks they go 25.
Ultimately, this comes down to messaging. How can the Fed justify a 50 basis point rate cut unless they see something that looks like actual weakness? And at this point, I just keep going back to, if that scenario bears out, could that be good news for the market? Essentially, it's not that big of a difference, but the Fed's going to be much more accommodative as a result. Can you really get that? I guess I'm wondering. He's kind of alone in that kind of call.
And if all the strategists are saying that Powell wants to make sure he has consensus, how much easier when you have, say, someone like Raphael Bostic, who over the weekend was saying he's still focused on getting inflation down to 2%. How much easier is it to get someone like him on board to 25 as opposed to 50 when Marvin Lowe says 50 will look political?
On Wall Street, we're still talking about the destination. And ultimately, is it in the low threes, the mid threes, somewhere close to 4? And I think the conversation we've had on this programme repeatedly is the Fed is offside by as much as 100 basis points, maybe even more. At the Federal Reserve, I still hear them talking about the journey. Gradual, methodical, gradual, methodical. You hear those two words on repeat in Fed speeches over the last few weeks.
And that indicates that they want to move slowly, that they want to move 25, 25, 25. Ultimately, when you take a step back, I find it very interesting. We talk about the destination, methodical, gradual, to what? We aren't talking about the destination. And I think that's the reason why James Camp was really interesting. We were just talking to him about how essentially inflation is going to be higher. The Fed's going to have a higher terminal rate. They're not going to address this because guess what? They've got no agreement and they have no advantage to really addressing it, but they're all saying maybe around 3%. Is it substantially higher than that if they start cutting more aggressively this year?
The opening bound 1 hour and about 26 minutes away to kick off the month of September. Equity futures right now negative by 0.5, advancing for 4 consecutive months in both equities and bonds. Yields dropping again last month on a 2-year by more than 30 basis points, dropping just a little less on a 10-year maturity, but pulling back nevertheless. We're at 390.92 on 10s, advancing on the session by almost a basis point. In the FX market, the euro against the dollar, 110.37. We're negative by 1/3%. Coming up this hour, we'll catch up with Kevin Gordon at Charles Schwab as stocks hover near all-time highs. Matthew Dolgin of Morningstar, I'll get that out, as direct TV customers are left in the dark over a Disney dispute, and Greg Daco of EY on why he sees softer economic activity to end the year. We begin with the big issue. Stocks kicking off September near all-time highs as investors await the Fed's next big data point, August payrolls. Kevin Gordon of Charles Schwab seeing a 25 basis point cut this month, saying while the Fed has made a definitive shift in the risk management practices, with labour now more important than inflation, it's hard to find crisis-like data that warrant aggressive rate cuts right now. Kevin joins us for more. Kevin, welcome back to the programme. I'm going to kick this conversation off with a quote from HSBC and Max Kettner. Max Kettner came out over the last few days and said high-frequency data have improved. Jackson Hole brought the Fed put back with a vengeance. We remain overweight equities. Is that sufficient reason to stay long and strong this equity market?
Yeah, I think it is, especially if you, as much of the discussion has been this morning, if it's going to be this slow and more methodical cutting cycle from the Fed, historically that tends to be more beneficial for the stock market versus something that's more aggressive and a fast cutting cycle. And, it's probably somewhat obvious, but if it's the latter case, it's typically because the Fed is reacting to worse economic data or some kind of financial crisis that's been brewing. So it's why, a lot of our message regarding the cutting cycle when it eventually starts is that you really want to be careful what you wish for if you're going for something that's more aggressive and if the Fed has to start going by 50 and at every single meeting. I do think there are some unique aspects of this cycle where, maybe that could be warranted given how tight policy is now and given some of the softening trends in labor. But if everything's holding up relatively well, if you get a nice package of data this week, which is basically looking to soothe, what was so weak a month ago for this exact package of data that we're getting, whether it's ISM related or payroll related, I think that sort of keeps us keeps the Fed certainly in a camp that is more, I would say, more sympathetic to something that's a little bit slower and a little bit less aggressive.
You've noted repeatedly the volatile shifts in leadership over the last few months. Kevin, would you expect that volatility to continue, or would you expect to see some durable leadership trends in the months to come?
I think the volatility, it's basically looking like over the past month, certainly, it's looking like a reversal from what has happened and what's been the case for most of this year up until the mid-July peak. And, we'd been calling it the Michael Caine, the duck market, where it's looking calm on the surface, but paddling like the Dickens underneath, because everything at the, up the cap spectrum that was dominated by big tech and to some extent communication services, that was keeping the indexes afloat while you had all of this volatility and this churn underneath the surface. You had significant maximum drawdown activity from the so-called average stock. Now that's starting to reverse, where since the mid-July peak, it's been much tougher for indexes like the NASDAQ 100 to regain their all-time highs, yet you've got the equal-weighted S&P 500 surpassing its all-time high. You've got equal-weighted financials at an all-time high. Equal-weighted tech is again struggling for an all-time high. So I think it's been more interesting to look at the characteristics and the nature of this leadership shift. But because of that, subsurface activity might start to improve, and I think that's a healthy thing for the market, but it may not look as good up the cap spectrum, and you may be, to some extent, kind of pulled back a little bit or capped as in terms of gains for the headline index level. I don't think that's a terrible scenario, especially because gains for the index, like the S&P 500, still look, relatively great year to date, but it's just going to be a little bit harder if you don't get those mega cap names that are contributing more to the index. But subsurface activity down the cap spectrum spectrum, you have started to see more improvement. You've got 80% of members in the S&P that are trading above their 200-day moving average. You've got more than 2/3 of members that are outperforming the index over the past month. So I think it has been a relatively healthy improvement, even though leadership shifts have been volatile, and we continue to expect them to be volatile too.
That said, a lot of these shifts that we're seeing, the paddling duck market that we've heard Amy Wu Silverman talk about, a lot of that has really come with this belief in a soft landing, with this belief that the economy is really generally moving toward recovery, even if you do see some consumer pushback in certain sectors. What would you have to see in the labor market, either on Friday or beyond, to really challenge the rotation into cyclicals that you're supporting?
Well, I think you need to see more of a definitive move higher in the unemployment rate, which, of course, you could argue that has been the case. But for many reasons we've all discussed, whether it's the triggering of the Somme rule or if you start to look at some of the innards of the unemployment rates increase itself, a lot of it has been because of this expansion of labor supply. I am sympathetic to the argument that immigration this time has played a particular role in that. You haven't seen, layoffs and other layoff-like data, whether it's claims or challenge or job cut announcements, corroborate what has happened with the unemployment rate. So I don't think it's something that we should ignore. But I do think that if you got something more definitive in terms of layoff increases there, plus a more material breakdown in payroll growth itself, especially in the non-cyclical sectors that have been holding up payroll growth pretty much for this entire post-pandemic cycle, that I think would probably challenge it more. It would probably send you into a more so-called traditional recessionary environment. But the whole discussion about a soft landing, we think the debate is much more nuanced than just soft landing or not. But if you're going to use that term, much of the discussion you were having this morning about destination versus journey as it pertains to the Fed, I kind of view it the same way with a soft landing. We're sort of living it now. If you think about the path in inflation that we've had, the progress that we've made on the disinflationary front, plus the fact that the labor market in aggregate has not fallen apart. Yes, you've had rolling weakness, and we've called them rolling recessions under the surface in different sectors at different times, but that's kind of a better way to go through, a recession rather than everything falling out and the bottom falling out all at once. So our base case is still that you get that kind of behavior, and it just moves and transitions out of certain sectors. And you could argue we're transitioning out of the recessionary activity for manufacturing and housing, but it's taking a little bit longer. The nice offset, I would argue, is that as the Fed starts to alleviate the pressure from rates and starts to bring policy down or restrictive policy back a little bit, that probably helps those sectors, as you've still got, relatively offsetting strength from services and labor. So I think that's why it shifts so much of the focus to the labor market, and rightfully so, why the Fed is shifting the focus there. But I think that as long as you're continuing that dynamic, you sort of stay in a relatively healthy territory in aggregate for the economy.
This seems to be sort of the consensus. I was reading a lot of notes over the weekend that largely agree with that view, that there is a sort of rolling recovery, and this is the soft landing, and this is what it feels like. And then it was a therapy session. It was basically saying September tends to be a bad month. Get prepared. It always has been. It has been for the past 4 years in the stock market, 7 years in the bond market. Just close your eyes. After that, there should be some calmer times and maybe even a buying opportunity. Is that basically the therapy session that you've been having with your clients?
I think that September, yes, there tends to be some surprises. I think that for this in particular, this quarter, or this sort of part of the year that we're entering, you're entering, at least from the U.S. equity perspective, in a position of relative strength. I mentioned 80% of members, trading above their 200-day moving average in the S&P, and this, I think, improvement that you've seen under the surface of the market. So I think that's a better place to be than where we were, a couple of months ago, where, in June, you got to a much weaker point in the market where significant deterioration under the surface, and there were so few members that were outperforming the index. You really just had the large caps that were holding everything together. Now we've reversed that dynamic. I think it's a better setup. But that doesn't mean that you can't have surprises along the way, whether it's geopolitical related, whether it's just domestic politics related. But I think that the overarching theme and what was so important about the drawdown that we had a month ago, and the volatility that we had, is that longer term breadth was basically unfazed. And I think that's a much more important story, in the fact that it was more, most of the weakness was concentrated in a couple of sectors, really just tech and communication services. If you look at the rest of the market, you weren't getting this recessionary like signal, whether it was from industrials or financials. So I think a lot of the behavior from from individual sectors, individual industries, becomes a lot more important, especially as we start to approach, the cutting cycle, and we start to approach sort of data that starts to look maybe recessionary on the surface, but warrants a much deeper look under the hood.
Kevin, love catching up. Kevin Gordon of Charles Schwab. Kevin, thank you, sir. Doesn't feel like an up 20% year on the S&P, does it? 2022 felt like a down down 20, 30% year on the NASDAQ. It really felt that way for big tech. Doesn't feel like an up 20% year at all in 2024.
Yeah, because people have been crying the whole way up. And basically people have been saying something's got to be wrong. And the whole time, nobody could really coalesce around some sort of narrative. So is this what a soft landing looks like? Basically unsatisfying rallies and unsatisfying goodness that people can't really accept.
You have to remember where we were in 2023 as well, that spring. Felt like the cycle was over.
Yeah.
Banking sector was starting to crack. Fed would have to cut. They carried on hiking. It's been very, very difficult to read everything post-pandemic over the last few years.
Which is the reason why people don't trust the data and they don't have a good sense of confidence around this soft landing, not to mention the fact that the Fed doesn't have a very good track record of actually achieving soft landings. But there's a feeling of a lack of confidence. What's the next shoe to drop?
Futures right now dropping by 0.5%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Hewlett-Packard says it intends to pursue a $4 billion damages claim in London against the estate of the late British tech tycoon Mike Lynch. HPE won a British civil case over the collapse of Lynch's company, Autonomy. It's now waiting for a ruling on just how much is owed. Lynch and his daughter were among those killed when his luxury yacht sank in Italy last month in a severe storm. Cathay Pacific has canceled almost all of its scheduled flights from Hong Kong to Singapore. It's inspecting the engines on its Airbus A350 planes. Sources told Bloomberg that engineers are checking for deformed or degraded fuel lines on the Rolls-Royce-made engines. A component failure had forced the return of a flight from Hong Kong to Zurich on Monday night. The airline says it's already found some component failures across a number of engines. Volkswagen shares, they are trading higher on the day, about 1 1/3%. The company said it's considering unprecedented factory closures in Germany. VW's main target is its underperforming passenger car brand. Profits margins are getting squeezed there in the EV transition and a consumer slowdown. Any shutdowns in Germany would be the first in the company's 87-year history. And that's your Bloomberg brief. John.
Danny, thank you. There are something like 650,000 workers at that company, and around 300K work in Germany. That is a big, big headline to read over the last few days.
Especially because it's not alone, and it's not going to be the last one. And that was basically the message that we've been hearing. It's overcapacity in a region where auto sales have come down, and this is the main industry that's being buffeted by everything, and frankly, that had been upholding the German economy.
Germany is not in a good place. Up next on this program, we'll get you some morning calls, and we'll catch up with Matt Dolgin of Morningstar as DirecTV viewers are cut off over a dispute with Disney. That conversation up next. You're watching Bloomberg TV. The opening bell 1 hour and 12 minutes away. Equity futures negative by 0.5%, pulling back just a touch in the bond market. Yields higher by almost a basis point, 391.30. Let's take the opportunity to get you some morning calls. First up, Evercore ISI upgrading Southwest to outperform with a $35 price target. The analyst citing new revenue initiatives set to be outlined at the company's Investor Day on September 26. Your second call from Morgan Stanley lowering its price target on Alphabet to 190 from 205. Keeping an overweight rating, the analysts weighing potential fallout after a judge ruled the company illegally monopolized the search market. We're down there by 0.6%. And finally, Wells Fargo downgrading Boeing to underweight with a street low price target of 119. The analysts seeing the company's free cash flow peaking by 2027 as aircraft development costs offset production growth. That stock, that name is down by almost 3.8% in early trading. That's one to watch at the opening bell. Turning to streaming, DirecTV customers losing access to ABC and ESPN after the pay TV service and Disney failed to come to terms on a new contract. Matt Dolgin of Morningstar, who maintains a buy rating on Disney, expecting the blackout to be resolved by the weekend, writing Disney is in the stronger position as it can more easily withstand the loss of DirecTV than DirecTV could withstand the family of Disney networks. Matt joins us now for more. Matt, not the first time we've seen this, and when we do see this, it's typically around this time of the year. What's different about it this time around?
Well, there's not too much different in this one. As you said, we see this pretty frequently. It seems to follow the same playbook, and eventually these things get resolved. The thing that is becoming different is that with streaming, the cable bundle is going to change. So although this one might not look different than the past ones, and we expect it to get resolved in the same way, we think coming up pretty soon there is going to be a bigger change to the pay TV packages that these distributors, the cable companies, the DirecTVs of the world get and are allowed to put out there. So although this might not be the one where we see the big change, we do think that's coming.
So let's talk about that a little bit more. What will that change actually look like in practice in years to come?
Well, right now, what DirecTV is looking for is the ability to offer a skinnier bundle, basically not having to put in this case, all of the Disney family of channels into their streaming packages so they can offer their customers packages for a lower price. The network providers like Disney have been resistant to that because the business model for these companies has been get people forced essentially to subscribe to all of your networks, and that's their best way forward. The thing that's going to be different, however, is that with streaming, there are becoming other ways to see this content other than through a pay TV package, and that's going to actually next year become even more, and probably to the greatest extent, once ESPN, the linear, the flagship service that people watch on only TV right now, becomes offered to consumers also. So that's the biggest thing, again, right now that's going on with DirecTV. The other thing that we think is a good way forward is what we've seen Charter do, the cable company. They did it with Disney last year. They subsequently did it with Paramount, where they're offering a similar type of bundle, but their subscribers get the stream packages of these companies along with their cable subscriptions or their pay TV subscriptions. So those are the couple of ways we think the changes will come, and we expect them to happen, even if, again, not necessarily in this deal and not quickly.
Can you zoom out and give us a sense of where this dispute, which is a couple years running now, sits in this overall shift away from cable to what purportedly should be the new future, which is, we don't know what, maybe another bundle that just looks a little bit different, but something that excludes the cable companies?
Yeah, and that's the thing, is we do think that another bundle is the way to go. The question is, who is it that offers it? Is it these traditional pay TV providers, or do the streaming companies do it themselves? As I mentioned with the Charter deal, we think that the cable companies and the pay TV distributors are the ones best positioned to do it. But as far as why it's happening, that is the point, is the companies that rely on pay TV, so the cable companies, the DirecTVs, their businesses are shrinking drastically as we see more cord cutting, and they need to be able to do something different. One of the reasons we think DirecTV isn't necessarily the company that's going to be able to cause the biggest change is because it has less leverage, in part because it relies on pay TV a lot more. And so it's in a bad position like the rest. Its subscriber base is coming down very much, and there's really nothing these companies can do about it because consumers have the ability to go through streaming and they're preferring it in many cases. The difference, though, with the cable companies versus DirecTV is that they rely much more on broadband revenue than pay TV revenue, certainly for profits. And they also have bigger, more diversified businesses otherwise, in many cases, certainly with Comcast. So they would have better bargaining power to drive that change. But ultimately, what's happening is pay TV as we knew it, or cable subscriptions as we knew them, for many, they've gone away. They are changing very much. And so that's what this ultimately will be about, is that this can't be the same thing year after year where, each side is trying to get the best rates for themselves in an industry that goes on. This industry is different now, and it will be much more different in the future. And the business model has to adjust for both sides, we think. And so that's what will happen. Again, even if we don't think this deal that we expect to be resolved most likely by the time the NFL season starts, which is what we often see, might not be the one to drive the major change that we expect, again, probably beginning more in 2025 when ESPN does become available for subscribers through streaming.
And then we'll do it all over again and again and again. Matt, thank you, sir. Matt Dolgin of Morningstar. It just keeps going round and round and round, this industry. We're heading back to where we started.
Yeah, although I do wonder how long before cable news channels don't have sports anymore, because they're getting too expensive for the cable news channels. And at a certain point, they're just going to be streaming channels and broadband channels and not actually offering content.
To Matt's point, it looks like one side has leverage and the other side doesn't, and that side is Disney. Disney has the leverage here.
It's a content provider at a time when ultimately people just want their sports and they're not really allegiant to DirecTV. People like yourself will just go subscribe somewhere else. And that's essentially what's
Wouldn't
been
you do
happening.
that almost immediately?
Of course. I mean,
you're not tied in.
Yeah, that's exactly it, though. The barrier to entry is that much lower because you can just get it on Roku or you can get it on your computer. You can get it wherever. You don't have to depend on DirecTV.
Just move on and get your sports where you can get it. Coming up, Greg Daco of EY and Brent Schutte of Northwestern Mutual from New York. Futures positive or rather negative by 0.5%. Your opening bell 1 hour and about 4 minutes away. $60 minutes away from the opening bell. Equity futures on the S&P negative by 0.5%. On the Nasdaq 100, we're down by 0.6. On the Russell, the small caps down by 1 full percentage point almost now. If you switch up the board and turn a page and get to the bond market, we'll sit at the front end of the curve once again. The 2-year 393.32, up by a single basis point after declining for 4 consecutive months. The longest such streak going back to, I believe, the early 2020s, Bramo. It's been a while.
I believe November 2021. And the reason that people are really embracing this idea is because the Fed opened up the door to it. You said that you should have a drinking game every time they say gradual or methodical. And then you pointed out that you should have a drinking game every time that Fed Chair Jay Powell speaks, because that's essentially what the market has done. And that is essentially what you're seeing. Is this the hangover? And that's what people tend to see in September's.
We'd be very, very drunk through the month of August, that's for sure, if you were playing that drinking game. Let's finish on foreign exchange and talk about the other side of the trade, so to speak. Dollar yen, 146.20, a stronger Japanese yen. Off-session lows granted, but still stronger. Some comments from the Bank of Japan governor in a document presented to the government, reiterating his stance that they're set to raise interest rates once again if forecasts and the economy, I guess, evolves in the way they expect.
This really goes to an anxiety people have. We talked about U.S. exceptionalism almost in isolation as everything else was in exceptionally badism. And people are wondering whether you're going to see that trade unwind and what that could look like. And you're talking about it through currency, but you're talking about it also through asset prices. At a certain point, if the U.S. isn't the only game in town and Japan is doing better and you're seeing the equities actually rebound a bit too, well, then what's to say people in Japan aren't going to bring all their money home? I mean, they were some of the biggest buyers of U.S. assets. And this is sort of the fear underpinning this weakness that we're seeing in the dollar. Is it just the opening salvo to a bigger story?
You sound like Stephen Jen. Is that how far you're taking this?
I'm not taking it there. Some people are. I think it's an interesting theory.
An avalanche of money and a 10% appreciation in the Chinese currency. Similar story, similar story.
Kit Jukes had a similar story as well. There is a fear out there. I'm not saying it's legitimate, but there is something to this idea that there has been a lopsided trade to U.S. assets.
We talked about it last week together. We've built up a big long position, accumulated a big long position in dollar assets over the last few years. Under surveillance this morning, Vice President Kamala Harris joining President Biden in declaring U.S. steel should remain American-owned. Harris telling a union-heavy crowd at a Pittsburgh campaign stop that she will, quote, always have the backs of America's steel workers. This issue becoming a non-issue because ultimately there's no daylight between the two parties.
Right. Both candidates say that it should remain in American hands. And to Henrietta Treyz's point, investors who were asking about this 1 year ago were correct. Nothing's going to happen regarding this deal, basically, until after the U.S. election. And then if it does go through, that individual, according to Henrietta Treyz, whatever candidate becomes president, will say, well, regulators have to go through it and it's on them. But from an American standpoint, for both these individuals vying for the White House, you can't go to steel workers. You can't go to Pennsylvania and you say you want this deal to go through. But for Kamala Harris, this is important because she brought Joe Biden along and she's trying to get blue collar workers, that idea of the Scranton Joe voter, on her side.
Does it seem like all the politicians are going to say they oppose it and then after the election they're going to go prove it? I mean, essentially, isn't that the playbook that everyone's expecting in markets?
Is that what you're expecting?
I mean, essentially, people are saying this isn't a viable company without some sort of infusion. They've already rejected an infusion from Cleveland Cliffs, which is a competitor, a U.S. steel competitor. Who else is going to do it?
Well, what they'll do is put their hands up and say, well, if the regulators allow it, we're not going to get involved. But
so yes,
it's going to be politically, it'll bite either one of them, depending on who gets into the White House.
So we've seen union chiefs line up, some of them behind Harris. Union rank and file, union workers, are they doing the same thing?
Not all of them. And we've seen this in polling. Trump has been able to, since really 2016, chip away at rank and file voters, which is why you see Kamala Harris in places like Beaver County, Western Pennsylvania, a county that, 60% pretty much went to Donald Trump. He has been able to get in the rank and file voters, which is why Pennsylvania is so crucial. And Josh Shapiro told me at the DNC, he sees it basically practically a statistical tie right now, which is why Harris continues to go to places like Pittsburgh.
That's the latest on US Steel. Let's get the latest on the smartphone wars. Chinese tech giant Huawei preparing to launch a new phone on September 10th, just hours after Apple unveils its latest iPhone lineup. Sources telling Bloomberg that Huawei is expected to announce the world's first commercial-ready smartphone that folds not once, but twice. Do I need it to fold at all? Do I?
Love this story. It's like our phone doesn't fold once.
It folds twice.
It folds twice.
Do we need it to fold twice?
If you look at the actual ads, you drop it. You can throw things at it. You can, play catch with it.
It's like the Cybertruck
it's gonna
of
be
smartphones.
Fine. Exactly. Take a bat to it. There's also this point about more screen space. It's sort of the latest new thing. But are we now talking about folding instead of AI? That's what I want to know.
The state of innovation. We're going back to hardware and not focused on the software. I thought this was meant to be like the moment for AI.
Didn't Apple win on hardware? Didn't they win on making it beautiful, on making it nice, and making it cool? And is that Huawei's game plan at a time where it's very hard to get an edge in AI wars that are really heating up very quickly?
I also think Huawei, especially going hours after Apple, this idea of nationalism and pride, a national giant when it comes to the smartphone maker in China.
Been a big thing for consumers in the mainland. Elsewhere, markets kicking off a shortened trading week, but there will be no shortage of data. Investors looking ahead to Friday's August payrolls report set to either confirm or deny a September rate cut. Greg Daco of EY remaining in the cut camp, expecting a 25 basis point move in 2 weeks that will kick off 75 basis points total for the year. Greg joins us now. Greg, welcome to the programme, sir. It's good to see you.
Thank you.
I'm not sure what kind of number would stop them from hiking next month. What kind of number would stop them from cutting next month, rather?
Well, I think if there were to be any signs that inflation is really accelerating and that we're seeing a labor market that's really strong, then perhaps they would hold back. But I think right now it's really a done deal in terms of the rate cut. The question is really the magnitude and the speed of rate cuts going forward. How rapid is this recalibration process going to be?
25 versus 50. We've had a few guests come on the programme and say something like 100K, 125, maybe south of 100K. Would nudge that to 50. Where are you on that debate?
I don't necessarily think that we have to have a payroll report that is as strong potentially as 100K to have 50 basis points. I think the 50 basis point rate cut is really going to be dependent on an environment that is much weaker than what we're seeing right now. The Fed does not want to be appearing as recalibrating monetary policy rapidly in an environment where the economy is still relatively strong. Let's not forget, if the economy is moving at a pace of about 2%, which I think is the underlying pace of the economy right now, that's not a reason to start panicking and cutting rates very rapidly. It's a time to start recalibrating monetary policy, avoiding monetary policy being excessively restrictive. But let's not move from an inflation obsession to an employment obsession, which I fear is what's happening in markets right now.
That's exactly where I wanted to go. If you put markets on a couch, and you really started to talk to them, I'm serious. Everyone's looking for the boogeyman. Yeah. They're all looking for when the next shoe is to drop and why they're missing some sort of harder landing that they're actually experiencing. That's sort of the vibe that you're getting right now. How do you explain that?
I think it's very important to navigate the nuances in terms of the economy today. I wrote this in my recent newsletter where you have to focus on the broad trends across different sectors of the economy. And what we're seeing right now is an environment where we have real disposable income growth that is quite moderate, around 1%. GDI that came out along with GDP was also on the softer side, 1.3% growth on an annualized basis in the second quarter. So the income side of the economy is what has me most concerned. It's not a reason to panic, but it's a reason to understand why consumers are going to be more prudent going forward. Look at the saving rate, 2.9%, the lowest since 2022. The resources that consumers have to spend are more diminished than they were a year ago. So you're going to see a little bit more caution, more judicious spending patterns from consumers, especially at the lower end of the income spectrum. That's going to lead to a slowdown in economic activity. But right now, we're not seeing any signs of a retrenchment in terms of economic activity. And that's because the labor market is still holding up. And business leaders that we speak to are not talking about massive layoffs. They're talking about being more prudent in terms of their hiring and investment decisions in an environment where cost fatigue and high interest rates are still very much part of the picture.
Is there a historical analog that you can kind of provide to people who look at all of the times that the Fed has tried to get ahead of some sort of downturn and failed?
I mean, there are a number of occasions in the past where the Fed has been a little bit late to the game, whether it's as recently as tightening in the face of inflation that was more persistent than expected back in 2021 and 2022, or if you go back to the prior crisis, the financial crisis in 2007, 2008, where again, the Fed was a little bit late to ease monetary policy. There are a number of instances where you can point to the Fed being late to recalibrating monetary policy. But I would point to just before the COVID crisis. Back in 2019, the Fed was said initially, and bad communication, but the Fed said that it was on autopilot with regards to the management of its balance sheet. Then it recalibrated by implementing 3 consecutive 25 basis point rate cuts. That was the right type of move, albeit a little bit late. I think right now what the Fed needs to communicate, now that it has communicated its views on the state of the economy and the state of monetary policy being slightly too restrictive, it needs to focus on the destination of travel, because that will determine the journey, the pace at which it eases and recalibrates monetary policy. We do not need to slash rates to zero. We just need to have monetary policy go from restrictive to neutral, given the underlying state of the economy.
Let's put some numbers on that. So
Yes.
Currently 550. What's neutral?
Neutral, I think, is closer to 3%. But neutral, that's neutral today. Who knows what neutral will be in a few months' time? How rapidly do things shift, right? If we are in an environment where we look at the last year and consider the last year we were talking about the last inflation mile being the most difficult.
Yeah.
Look at the conversation today. It's not about inflation anymore. We're within striking distance of the Fed's 2% target. One concern I have is that Fed policymakers are themselves too concerned about getting right back to that target. We're within 50 basis points of that 2% target. Do you want to fight the fight to get back to 2%? Or do you tolerate some band around that 2% target and allow the recalibration of monetary policy, given that underlying demand and underlying labor market trends are softening?
Can you point to some Fed officials that have given you that impression over the last month?
Well, I think Fed Chair Powell was right on point in terms of his Jackson Hole statement. We do not seek or welcome any further weakness in the unemployment market. We do not consider this environment an environment where we need to panic, but we need to respond adequately to inflation risks, to risks to the outlook. That's the type of communication we need to have. The problem, and you mentioned this before I came on, is that not all policymakers are on the same page. You're still talking a lot about gradualism, being methodical, and the drinking game is one that worries me quite a bit because we are in this environment where perhaps you may need to accelerate the pace of easing, but let's pay attention to the outlook, not so much today's conditions or last month's conditions, which tends to be the case for markets.
Greg, when you look at the destination, and you're talking about the neutral rate, but everyone's talking about the end of the year, how does the Fed look at the destination for next year when policies may be very drastic depending on who gets into the White House? I'm thinking of things like tariffs and what that means for inflation. The Peterson Institute says you could see the Fed turn around next year and start hiking again.
Yeah, that's a great question, because right now the Fed is behind the curve when it comes to current economic conditions. I think it should have been easing. We've talked in the past about my perspective that the Fed should have been easing from early this summer, not in September, but earlier in May, June, maybe even July, in terms of starting to recalibrate monetary policy. That's just catching up to the current conditions of today. I'm not talking even about the next 3 or 6 months. I'm talking about today's economic conditions. When you talk about next year, that's another step. So essentially, the Fed is 2 steps behind when it talks about calibrating monetary policy to tomorrow's economic activity. You're absolutely right. There could be a lot of uncertainty in terms of the direction of travel of inflation in tomorrow's economy, where you could have more tariffs, where you could have an environment where there is greater influence on the Fed, where there are restrictions on immigrations that could lift inflationary pressures due to undersupply on the labor front. Those are all conditions that could materialize. But that's the unknown. The Fed does not want to bank on any unknowns at this point. It wants to bank on the known knowns and the next 3 months in terms of the direction of travel of the economy.
Greg, this was smart. It's great to catch up. Thank you, sir. Greg Daco
Always a pleasure.
Of EY. We are about 45 minutes away from the opening bell. Futures are negative by 0.5%. To continue the conversation, joining us now is Brent Schutte of Northwestern Mutual. Brent, let's extend this conversation. Just how offside is this Federal Reserve?
I'm not for sure they're offsides yet. I mean, I think the Fed's going to cut 25 basis points because they see signs of labor market weakness. And I think those signs have been more pronounced in the last 6 months. And so I don't think they can sit around and continue to wait and say, we don't see it, because it's actually happening underneath the surface. And that's where I think they cut 25 basis points. But I don't think they go fast, and I don't think they go hard unless they see some sharp deterioration, because you are later in an economic cycle. And one of the nightmares they have is that they cut too early and they have to hike later, which could hurt people's inflation expectations, because people may believe the Fed doesn't fight inflation any longer. And that's where I think a lot of them are concerned in that scenario.
Okay, Brent, let's just go there, because it seems like the tone of the discussion, and this is something that Mohamed El-Erian has talked about, this is a one mandate Fed at this point. It's about the employment market, not the potential for inflation to revive. How much are you actually adjusting your positioning around the idea that there's more upside risk in inflation right now than currently is being given credence in markets?
It's something we're certainly discussing. I mean, to me, if you look, I'm not for sure that inflation is dead. It has come down. We had a head fake last October, November, where you saw inflation at similar levels to today. The Fed expressed optimism, and then financial markets ripped, and then you saw inflation come back. And so to me, at the end of an economic cycle, the economy is highly sensitive to changes in demand expectations. And that's where I worry that the Fed right now potentially is going to spark another inflation bout, because there are things happening like the market going higher, like people being overweight equities and that sentiment surveys being really high. And I think that could actually bring inflation back later in the cycle here.
When I was talking about putting the market on the couch and kind of analyzing what the anxiety was coming from, I was actually talking about you, Brent. You talk about how they're essential of a Hollywood ending is actually the soft landing, and that's usually what people are hoping for. But you believe there is still another twist that's hanging out there. Is that higher inflation what you're expecting?
Look, I think it's more likely that we still have a recession. I know no one wants to say that any longer, but if you look at the labor market, I mean, it tends to trend, and right now it's fallen by 9/10 on the unemployment rate. I know the non-farm payrolls were strong, but that narrative took a hit the other week, did it not? And so to me, you've seen the labor market weaken, and it tends to not stop at up 0.9%. It tends to trend up to something much higher. And I still think there's a probability that you get that recession, which certainly the market is not priced for. People are incredibly optimistic. The AAII sentiment surveys in the 50s. The CAPE ratio, for example, something that people have forgotten about, is at its third highest level ever, only behind the end of 2021 and then 2000. To get another higher number, you have to go back to 1929. And so there are lots of warning signs right here and lots of reasons to be cautious. And most people aren't right now. And that's my big fear.
So let's have a conversation about capital allocation decisions, Brent. How does that influence your thoughts about making a decision between small versus large caps? And when clients start to ask questions like, I've got this big position in big tech, how defensive will that behave in the economic downturn? What kind of thoughts are you coming up with the team?
This is where I think there's opportunities and things that aren't so obvious to people because they are more economically sensitive, but I think they've been priced that way. And so I mentioned the parts of the market being expensive. I think of things in 3 to 5 year chunks, and valuation tends to have a better probability of providing positive returns or positive outcomes in that time period. I like small and mid cap because they have priced in more of an economic recession. I don't think that means they won't go down, but I don't think I can time that downside and then get back on the upside. And so we are overweight there within the context of being underweight equities as a whole and being more allocated towards fixed income, which I do think the Fed will be able to cut aggressively to find that neutral rate if and when they do see that actual recession. And so fixed income right now with some small and mid cap added on top. And that's where we position our overall portfolios.
Brent, just to be really clear, you believe the risk reward is more compelling in small and mid cap versus large and mega cap tech?
If you stretch your horizons a little bit more beyond the next 1 to 2 months to potentially a couple quarters, yes, I do. I think long-term valuation tends to win. And I know that in this economic cycle, people shrug off valuation just like they did in 2000. And this has so many echoes of that to me. And that's what makes me a little bit more concerned in the near term.
Fascinating. Brent, appreciate the update. Thank you, sir. Brent Schutte there of Northwestern Mutual on small versus large and where we are in equity markets.
And the idea that he's more heavily weighted to fixed income, even though he thinks that people aren't necessarily appreciating the reinflation risks out there. The idea that if the Fed waits long enough, they can cut pretty significantly at the same time that you see some of the more overexpensive areas of the market lag behind.
Who else is getting therapy this morning? Is
well,
that what you're offering?
No, I'm offering lots of therapy. You can find me
Sit
in the
down
green
with
room.
Dr. Bramo.
Yeah.
Take a seat.
Come on, it's true. It's like, there's another wrinkle to this story. Da, da, da. I mean, it's true. Exactly. So what is it?
Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Elon Musk's Starlink has reportedly informed Brazil's telecom regulator that it will not comply with a court order to block X until its local accounts are unfrozen. Brazil's Supreme Court ordered the block based on X's allowance of hate messages and false information about the country's electronic voting system. Musk has threatened to seize Brazilian government assets unless property belonging to X and SpaceX are returned. Citadel Securities and Jane Street are on track for record annual revenue hauls. The two market-making behemoths are further eating into the big bank's trading market share. At Citadel Securities, first half net trading revenue rose 81% to just under $5 billion, and it was a 78% rise at Jane Street, according to people familiar. By comparison, Wall Street's biggest bank saw an 18% jump in equity trading revenue. Aston Martin's F1 team is making a big push to sign veteran engineer Adrian Newey. Newey is stepping down from Red Bull early next year after helping to create a car that's dominant on the grid. Aston Martin's billionaire owner, Lawrence Stroll, told Bloomberg he's pulling out all the stops to try to sign Newey.
Adrian is clearly the most talented and gifted individual in Formula One based on his track record and history, in addition to being a hell of a gentleman. So I'd be very excited for Adrian to join our team.
Newey is in high demand and has yet to announce his next move. And that's your brief. John.
Looked like he was in Venice. It's quite a life. Danny, thank you. Thanks for this morning. I think we should mention this. Ferrari, Monza, first time since 2019. Beautiful thing. Did you watch that over the weekend?
We should mention this,
we
really.
Should mention that.
All right. We should just happen to mention that Ferrari is way better. That's for John Farrow.
I haven't posted on X in months and made that happen over the weekend. I was compelled to tweet about it.
Can I just say, can you listen to anything that anyone's saying when they've got that kind of backdrop other than just fantasize about what their life is?
What did he say?
No idea, but it was a beautiful backdrop.
Up next on the programme. We'll set you up for the week ahead. They've got quite a life, haven't they? That's up next on the programme. We'll catch up with Bloomberg's Mike McKee in just a moment. You're watching Bloomberg TV. Lisa's on form this morning, that's for sure. 37 minutes away from the cash open. Equity futures right now negative by 0.5%. Looking at the bond market, yields lower by 2 basis points. The 10-year 388.24. Here's the trading diary. The week ahead, your calendar shaping up as follows: 9:45 Eastern, S&P Global US Manufacturing PMIs, the big one at 10 a.m. ISM data tomorrow. Jolts and durable goods, plus the Fed's beige book at 2 p.m. Thursday, ADP employment data, another round of claims and another ISM, this time on services. And the main event on Friday is the August payrolls report. Mike McKee with us around the table. Good morning, Michael.
Good morning.
What are you looking for on Friday?
Friday is the day, and we're looking to see if the forecasts are correct that we get rebound in job growth to somewhere in the 160 range, and we see unemployment fall a tick. If that happens, then people are going to feel a whole lot better. But beyond the jobs report, the most important thing that's going to happen this week is 11 o'clock on Friday morning. Fed Governor Chris Waller speaks. And he's going to be John Williams is giving some introductory remarks, but Chris Waller is going to probably set the tone for how people trade going into the Fed meeting in the 50-25, because you're getting a reaction from the guy at the Fed that everybody pays attention to. So that's what I would watch for.
If the Fed does cut by 50 basis points because of a small difference in the headline jobs number or the unemployment rate, how can they argue they're not data point dependent?
Well, they are, according to Jay Powell, not data point dependent. They're data dependent, the totality of the data. And they would look at other numbers. And remember, we get a CPI report next week, too, that comes before the Fed meeting. So they would have something else to hang whatever they do on. But they've got to get through to that point. And what's interesting is this week, I was talking to somebody here who was out last week who said, I don't know if I'm behind or not. I said, nothing's happened in the economy, and nothing's going to happen until Friday's jobs report, because we have all these numbers we think are important this week, but every one of them is going to be, here's the number, let's talk about how it affects Friday, and thinking about Friday. So it's a little bit like, for Anne-Marie, all the political stuff is going to be about, well, let's talk about how it affects the debate coming up next week. So everybody's got a lot to wait for. We got to show up because we get paid, but we'll be,
Mike, Marvin Lowe talked about the fact that 50 would look political. How bad does the number need to be for them to not look political?
Oh, I don't think they're going to worry about that. I think the issue is going to be more of what Lisa was talking about, the idea that then people get scared that there's something wrong with the economy. Greg Daco was making the same point.
Yeah.
That you don't want to go too far out without having something to point to say this is why we did it. There's enough people who are probably against it on the board that they don't, unless we get a surprise on Friday.
Does the quiet period start on Saturday?
It does.
Oh, very small window for Fed speak then. Michael, thank you. Coming up tomorrow, Russ Kostrick of BlackRock, Laurie Heindel of State Street, and the co-CEOs of On Running, Martin Hoffman and Mark Morrow. Looking forward to all of that from New York City. Thank you for choosing Bloomberg TV and welcome back from a long weekend stateside. This was Bloomberg Surveillance.